hit it.
It's Friday, March 26, 2021, episode 124. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome to the show Jay Pelosky from TPW Advisory. We have a great discussion about macro thematic investing, what exactly is a tripolar world, and we even find out what it was like to work for investing legends Barton and Byron Wien. Then we have the great pleasure to have Barton back on the show to announce the launch of his new service, Fed.Tips. After those two great guests, Patrick jumps in with a bit of black magic that he likes to call technical analysis in Talking Charts.
In This Week in Trading History, we look back at the panic of 1792, and we end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
So this week we are drinking Radical Road Brewing Company's 8-track IPA.
Yeah, I had to jump in and insist that after that last move,
no more coffee beers?
No more coffee beers. Coffee and coconut.
So let's find out more about this beer. 8-track was the go-to method to listen to your favorite riffs while cruising in the 70s. Bursting with citrus and stone fruit, our 8-track IPA honors this era by delivering a full-flavored beer in stereo.
Oh, it's definitely got a very strong taste. A little bit of bitter in there.
Yeah, it actually tastes like it's from the 70s.
Some of our
What does that
listeners may be
mean?
wondering what an 8-track is.
Yes, that's right. We should explain an 8-track. Patrick, did you have one in your car?
No, I did not. Yeah, it's only elders like yourself there that.
My folks had one. We had a cheap car, and we had the 8-tracks. For those who don't know, is exactly what it sounds like. It's before the cassette. And you couldn't actually fast forward. All you had to do is you could choose which track. So we had this Beach Boys album, and we knew when to move it so we could hear all the good songs. But anyways, I digress.
There you go. Kev, give us a disclaimer, buddy.
Okay, let's have a look here. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include buy-side bloat, the springtime side splitters. I'm having trouble saying that. And then there's actually two extra ones, and we had to do both of them. The Muir malaise, which is good, but it's not as good as the Ceresna shits. Big thanks to Seth for those. I really like that last one especially.
I hope no one suffers from those that last shits. One. All right, let's get to our first interview. So we have the great pleasure of being joined now by Jay Pelosky from TPW Advisory. Jay, thank you so much for joining us.
Thanks, Patrick. Happy to be here.
So it's Kev here. Jay, I went and saw you on an interview, and I have pages of notes because I enjoyed it so much. So I've been looking forward to this for a long time. But before we jump into it, why don't we get to know you a little bit better? Although you now live in New York, or you're a New Yorker, you're not really. You're from Beantown. Why don't you walk us through the journey from Beantown to New York?
Oh, sure. No, I grew up in Massachusetts, actually outside of Worcester, which is about 40 miles outside of Boston, Central Mass. And actually played hockey, and I think, as I recall correctly, hockey runs in your family as well.
Yes, it does, unfortunately. I've seen the inside of too many rinks.
Yeah, exactly, right? 7 o'clock in the morning and freezing your you-know-what off. Anyway, so grew up in Massachusetts and played hockey, but then ended up actually being a football player, American football, and went to school down south in North Carolina at Duke University to play football on a football scholarship. And studied political science there and enjoyed all that, and graduated, many moons ago at a time when the job market was tough. And so the advice was to go get a graduate degree, go straight to grad school. And I did that. And I got a master's in international politics from the George Washington University in Washington, D.C. And at that point, the suggestion was, you can read, you can write, you can speak. You need to get some financial background. And so I applied to one of the bank training programs, was accepted, and found myself going to New York for what was supposed to be, a 1-year, maybe 2-year stint, learning how to be a banker, and that was it. I had no aspirations to stay in New York. I didn't know much about the city, et cetera. And of course, as you know how life turns out, Kev, right? That was 30 plus years ago. And I married a girl from Brooklyn. And you know what they say, you can take the girl out of Brooklyn, but you can't take the Brooklyn out of the girl. So, you know, we're here. We're not going anywhere. I live right in the center of Manhattan, down kind of by Union Square, Madison Square Park, and have two boys. We have two teenage boys, and raising a family in the city, and have been here pretty much throughout the whole COVID situation, minus we spent the month of July out in Aspen. But other than that, we've been here, and you know, I think things are looking up as they are elsewhere, and you know, we're thankful for that, and thankful for some warm weather.
Well, that's terrific. So you've been your new city has adopted you. You are truly a New Yorker.
Well, I think 30 plus years should give you the authority, and then certainly having been here, you know, for 90% of the COVID experience, definitely should qualify.
Well, not only that, you're living in the city, which a lot of people, they call themselves New Yorkers and then they head out every night. You're a true New Yorker living in the city. So, but along the way, you know, you've worked at many different firms. Why don't you walk us through here?
Is that a dig?
No, it wasn't. It was honestly not a dig. It was a very impressive list. And why don't you walk us through, you know, how your career as a banker evolved?
Sure. No, I mean, just joshing with you, but it has been a long and winding career because it's been a long one. And so by most, you know, most long careers have some twists and turns, but let me see. So I went to that bank training program, which was a European American bank. So gives you a sense of how long ago it was. It was a consortium bank because they didn't really provide too many licenses for international banks back in the day. And went through the training program and realized pretty quickly, you know, I didn't really want to be a banker, but I wanted to be in the financial markets. And at the time, this is the late 80s to, you know, finally put a date on it. The late 80s, and emerging markets were starting to percolate a little bit. And I was an international affairs, you know, grad student. I supposedly knew about the world and had done some research and writing, and it was published by a few places. So I took that work and, you know, used it as my entree to get out of the bank and into the securities business, which I did with a firm that was aptly named Karl Marx and Company. Carl, seriously, I swear to God, Carl with a K and Marx, Carl with a C and Marx with a K.
Okay.
And so that was great. And, you know, one time, a funny story, you know, the Chinese were in town, a delegation, and I was able to go as a junior guy and was introduced to one of the members of the Chinese delegation. It's from Karl Marx and Company. And you could literally see the look on the guy's face when they translated it.
He thought these guys are going to get all of our business from now on.
Exactly. We're fast friends. So that was my introduction, and I was doing non-Japan Asian research. Okay, so late 80s, I was actually went to Asia, was there when they were writing down the stock prices in Jakarta with chalk on the side of the wall. There were so few companies traded. Went all through Asia, came back, and just in time for October 1987 and the crash. Oh. And that was a great introduction to Wall Street, because a couple months later, came back from vacation. It was in the winter, so had gone on vacation to the Caribbean somewhere for a week. Came back, called into the boss's office and said, you know what? The family who was behind the company is getting out of the business. You're fired, and goodbye and good luck. And, you know, no severance, no 2 weeks, no nada. So that was an awakening, and that led to my first foray into independent research. The couple of the guys that were in the research department and we started a company. That failed. And in the late 80s, very beginning of 1990, I found myself 30 years old. I was unemployed. I had eviction notices on my door. And I was working with the only way that I knew how to work at the time, which was as a waiter at the Forest Hills Tennis Club, where they used to have the U.S. Open, right? And as a doorman or a bouncer in Astoria, Queens, because I played football, remember?
So you're a big guy.
Had a big guy and had bounced, bounced in grad school and bounced in down at Duke. And so I was making cash money as a bouncer.
Okay.
And that's the job that I had before I joined Morgan Stanley.
Okay.
So you can just imagine the it's maybe 8 miles from Astoria, Queens to Morgan Stanley's offices in Midtown Manhattan. But it was like a couple of thousand miles in terms of different approach to things. Anyway, was hired by Barton Biggs on Morgan Stanley Asset Management. And the first thing they asked me to do, remember, non-Japan Asian expert, or analyst, not expert. And the first thing they asked me to do was to go down to Brazil and start a Brazil fund.
Okay.
And, the hubris of the investment banks, right? You don't have to know Portuguese. You don't have to know anything about Latin America. It's Morgan Stanley. You're a capable guy. Go do it. And so it was a great lesson, though, because it was Morgan Stanley and the arm of the World Bank called the IFC, who were doing country funds at that time, trying to develop capital markets in the emerging countries. And we couldn't raise a dime, couldn't raise any money. And it was a great lesson because if you go back and look, the absolute downward low was in 1990 in Brazil. So the time to invest versus the time to market are two very different things. And I learned that lesson very early, and it was a very good lesson to learn early on. So we did end up launching the fund. We launched a follow-on regional fund. I was all throughout Latin America in the early 90s. They then asked me to move to the sell side of the firm and start the Latin American equity research business, serve as strategist, which I did, which was just in time for the Mexican peso crisis in 1994, where another quick, funny aside, I had been hiking and camping in Humboldt County in California, beautiful with the redwoods and everything. And you know how you hear sounds at night when you're in your tent and you're like, what's that? And, oh, my God, you're going to get eaten by a bear, et cetera. So I come back and I write a piece entitled Bears in the Woods, arguing that, there was not going to be a devaluation. Don't worry about it. Stay firm in your positions. Naturally, a week later, Mexico devalues. And yours truly is front and center as the Wall Street Journal's villain on, Wall Street getting Mexico wrong. So Byron Wien, who was the U.S. strategist at the time, pulled me aside and said, young man, let me give you a little lesson. You can be wrong at the top and you can be wrong at the bottom, but you cannot be wrong at the top and the bottom. So you better find that bottom, boy. So anyway, I survived that and was promoted to do a global emerging market strategy product, which was the firm's first multi-asset, multi-regional research product in the mid-90s, 95, 96, which, of course, was just in time for the Asian financial crisis in 1997 and 98. And I've got all sorts of stories about those days, which I won't go into, other than to say one of the highlights was being in Bangkok in Thailand and being mistaken as part of the IMF delegation and practically being chased out of town. So that was the emerging markets. And I everything I did at Morgan Stanley, Kev, interestingly, was new, right? I was the guy who, when something needed to get created, started, developed, they turned to me.
Send in Jay. You're like,
exactly.
like Mikey likes it. Mikey will eat anything. Jay will do that.
Exactly.
Actually, I'd love to talk to you just before you go on about your career a little more about Morgan Stanley, because you were actually there during, two legends in the business.
Oh yeah.
Both Byron Wien, is that how I say it?
Byron
and Barton Biggs, like two absolute legends. Why don't you talk to us about, what made them so great, how they differed, any sort of color in terms of, their process would be great.
Oh, sure. Well, I mean, first of all, it was somewhat of a challenging environment. I was the young gun, right? It was Barton, Byron, and Steve Roach, who was our chief economist.
The three. I didn't realize that all three were there at the same time as you. Okay.
Oh yeah, no, it was a top-notch macro firm, and there were other younger guys, Richard Davidson and Stephen Lee Jen and Andy Shea in China, and a bunch of guys. They were really high-quality people,
right?
And anyway, so that was it was the old guys who like to have fun with the young guys. Barton was I believe, a Marine. So Barton liked to test you physically. And so like one of my vivid memories of Barton, who's passed away now, but vivid memory was going to Mexico with him. Because remember, I was doing Latin America.
Right.
And we were going to climb Popo. Barton was a big climber. And I had never done anything in the big mountains. I mean, I climbed in New Hampshire and, places around New England, but not, that's like 4,000 feet. Right. Popo is 18,000 feet. Okay. So you're talking about a different level of magnitude. And of course, Barton's there, and I'm like one of the only guys there. I was the Latin American guy, so I got invited along in the trip, basically. And, so I have to keep up with Barton, obviously, right? And I'm like, whatever, 32, 33, 34. He's like probably in his 50s at that point. And naturally, I got, wicked altitude sickness and, couldn't barely keep my head up for 2 days. It was brutal. So that was Barton.
And to be fair to you, though, young people are more likely to get the altitude sickness. There
you go.
I'll save you there and say
thank you.
That is not unusual for the old guy to be able to not get it and the young person to get it.
Okay, well, I appreciate that greatly. The other thing about Barton was that he was an avid reader, and I'm an avid reader. That's the basis of my work. Is I read and I synthesize, which I think you have to do in global macro. You have to be a really good synthesizer. And Barton, the thing that was so interesting was not only was he a great reader, but he always wanted to read stuff that differed with his opinion.
Okay.
And a lot of people like to have stuff, validating their opinion, right? Supporting their opinion. Oh, this guy, thinks like I do, and he's pretty well known and smart, so I must be right. Barton always was like, hey, you want to understand the other argument and kind of test your argument. So that was his. Those were a couple stories on Barton. Byron was very smart and intellectually. He was kind of the intellectual challenger, so to speak, within the group. And one of the things I remember about Byron, that I'm good friends with Byron and very good friends with his wife, Anita, great people. Byron was the guy who on Sunday night, so Monday was the macro session for Morgan Stanley research to talk to the sales force, right? Monday mornings. And that was all macro. And it was that lineup we talked about, so it was hard to get up on that podium. And you had to have something to say. And Byron was the guy who on Sundays would call all around the world and ascertain who had what to say. And of course, he'd start early with the overseas markets, with the guys in Asia and Europe, et cetera. By the time he got to me, it was like 10 o'clock at night on Sunday, which was a drag because it ruined my entire Sunday and my Sunday night, right? But yet that was the drill, and you had to pitch your tidbits there for Byron to decide whether or not to say, hey, let's get this guy up on the podium on Monday. But it was a top-notch macro lineup, and I learned a ton from those guys.
And Byron was the fellow that came up with the surprises, right?
Yeah.
Remind us again, what was that famous exercise that he did?
Yeah, the 10 surprises, ideas that Byron, and he would canvass a lot of people. And again, these guys were known by everybody, and everybody was happy to talk to them.
Right.
Like, for example, Julian Robertson at Tiger. He was the guy who basically ended up funding that Brazil fund because he was really good friends with Barton. And Barton asked him if he'd throw in like 10 or 15 million bucks to get the thing done. Right. And he did. So they would talk to everybody, and Byron developed those 10 surprises. And basically the thesis is, ideas that he thinks has something like a 50% or better chance of happening, where the consensus is that it has like less than a 25% chance.
Right.
So that's the odds. So he tries to be provocative, and he's kept it going, which is, I tried to do it for like a year or two, and I couldn't keep it up. And he's kept doing it for like 20 plus years at least, maybe longer.
Can I jump in here? I got to tell one story, and I don't know if I should tell it, but it's too funny, and I hope everyone takes it with a good humor. Byron was speaking at the Toronto CFA conference one year, and I was like, I got to go see Byron speak. This is great. And he got there and he started it off and he says, it's so great to be outside of the U.S. because, when I'm in the U.S., I have all these compliance issues and I have all these political correctness things so I can tell jokes like I want to tell. And he says, for example, and he proceeds to tell this joke. He says, a lot of people say to me, Byron, you're you travel all around the world. You go to a lot of different places. You must live quite an exciting life. And you're so famous and so important. You must have even been on the Concorde. And then Byron says, well, no, this is where I jump in and tell them, not a chance. I've never been on the Concorde. And they say, why? And he says, if I'm going to get on something that's 28 years old and goes the speed of sound, it better be wearing earrings.
Yeah, exactly. That sounds about right. And I'm going to leave it at that. I will leave it at that. But Byron, those guys, they were, it was a great group. And like I said, I learned a ton from them. I mean, I learned how to write. Barton was a great writer. He's an English major. He wrote a bunch of good books. Writing to get your stuff published in Morgan Stanley in those days was a challenge. Right. And it was great.
Okay. So then from there, Morgan Stanley, where do you head off?
Yeah. Well, let me just finish up. So I did global EM. Then I was asked to do global equity and work directly with Barton because he was the strategist, but we didn't have a product. So I developed that. And the last thing I did, and it's relevant to the rest of my career, so I just want to mention it, is I was asked to do a global asset allocation product, which was the firm's flagship, soup to nuts, fundamental research, technical, quantitative, all assets, all regions. We had an investment committee that Steve Roach and I co-chaired. And that was that's what I did for my last couple of years at Morgan Stanley, and then left the firm, got married, found out we were expecting a child, and decided that I'd been doing this for 15 years at that time, and was ready to take a break and raise a family, and so did that and managed my own capital right through the financial crisis of 2008, 2009. Okay. And then start using ETFs, by the way. So I've been a big believer since the early 2000s of doing global asset allocation investing via ETFs. I think they're a tremendous instrument and continue to believe that. And they only are getting better with the rise of thematic investing. And so over the last, let's call it 15 years or so, I've basically been either providing global portfolio strategy and asset allocation advice through a number of different firms. I had the IRA for a couple of years, TPW Investment Management, and now I am running TPW Advisory. TPW stands for the Tripolar World, which is a thesis of mine I've developed over the last decade, arguing that globalization is dead and regional deepening and regional integration in each of the three main regions of Europe, Asia, and the Americas is the path forward. And so that thesis is something that's really continues to play out and develop. And I have underneath that in my process, because I really do believe, and I'm sure you agree, Kev, that to do global macro, to keep everything organized, you have to have a process. You have to have a structure to the way you approach the world. And for me, it's this idea of a framework of the tripolar world. And then underneath that, what I call the global risk nexus, which looks at economics, politics, policy, and markets in each of the three main regions and globally. And that was a tremendous help over the last year and really helped set the stage for being able to invest through the entire COVID period, which I did as part of my work on the IRA, and now carrying that through with the closing of the IRA to the TPW advisory work, where I'm focused on offering clients a model portfolio delivery service, as well as that advisory and consulting business.
So that is one of the things that I like about you, Jay. When I watch you on Bloomberg or wherever, the CNBC, you always seem to bring it back to an actionable item. You always say, here you go. This is what I believe. And it's not just some crazy pie in the sky macro thing where you're buying, out of the money CNH calls or something. You take it back to everyday people and how they might invest for that. So I've really enjoyed that. So let's jump into your ideas and some of the kind of thinking behind your recent market calls. And one of the things that I just like to start with here, I'm going to read you a quote that you said. You said, "We are in the beginnings of a regime change of 40 years of Republican-led thinking that government is bad, big government is bad, and we need to shrink the government." So I'd like to talk about that because that is something that is near and dear to my heart in terms of I see the same change in terms of people's attitudes. And I'd just like to, just reiterate for everyone who's listening, when we as kind of market strategists look at stuff, often we're not expressing a view about what should be done. We're talking about what is being done. And maybe the two coincide, but maybe they don't. And just to be clear, this is something you've seen happening. And if I'm not mistaken, you think that this has important ramifications for the markets going forward. Why don't you speak to that?
Yeah, no, perfect. And I love the way you set it up, Kev, because that's absolutely right. Politically, obviously, people have their perspectives. But, one of the things I've always loved about the markets is that you have to be dispassionate. Otherwise, you're going to get yourself in a lot of trouble very, very quickly.
Right.
And so my own political leanings aside, whatever they may be, I do believe that we are finishing basically a primarily Republican framework, which was adopted to a certain extent by various Democratic governments as well in the United States, that began in the early 80s with Ronald Reagan in his famous comment about the 9 most terrifying words in the English language are, "I'm from the government and I'm here to help."
Right.
Okay, that's literally a quote.
Yep.
And I use that as one of my musings. I write a weekly musings column as well as a regular monthly report. And I use that as the title of one of my musings because it just caught me. And the Trump administration was the natural, logical conclusion to that mentality because the reason for being for the Trump administration was the complete deconstruction of the administrative state. That is, again, a direct quote from Steve Bannon at the time when he was leading President Trump's policy-making apparatus. And so that gave us, COVID and the very subpar response to COVID that we've had. And now we have a completely different mindset. We have a Democratic government led by Joe Biden, who is a creature of government. He's been in government for 40 years. Virtually his entire staff are former Obama people. And they understand that they have been presented with a real opportunity. And that opportunity is twofold. It's one, to get their hands around COVID and to solve it. And I think he's making tremendous progress on that front. And secondly, is to unleash an economic boom as the result of getting COVID controlled. And we're, I think, very close to the onset of that boom. And those two things then will provide the opportunity to do much better than typically is the case in the midterm elections. Again, hard to believe in a year and a half or so, 2022. And then the presidential elections in 2024. And we've gone from the mentality of the Republican ideology I spoke of to a much different world, to a world where people are crying out for government support and assistance through COVID, and also recognizing the huge challenge of dealing with the climate, and then addressing the inequality which has been manifest over the last decade or two, primarily because of the policy response of relying on monetary policy in particular to fix things post the great financial crisis, which has benefited guys like us who were in the markets, but not benefited Main Street and the broad populace. And so led us to the populism that was expressed by storming the U.S. Capitol, 2.5 months ago. So to me, this is a sea change. It's a paradigm shift. It's huge. And the Biden administration recognizes, and they're doing it. Go big and go fast. And they recognize that the Obama, as I said, ex-Obama people, they were too small and too timid in the aftermath of the great financial crisis. And Biden, for all his desire to be a bipartisan player and be, his senatorial experience, he has made a nod to working with Republicans. But if they don't want to work with them, he's using the reconciliation process to pass a $1.9 trillion rescue plan. He's now about to launch a $3 trillion climate and infrastructure plan. And this is big government moving fast and people being quite happy. The rescue plan, I don't know if you've noticed this up north, but the rescue plan was one of the most popular government policies in the last 50 years. It had over 70% approval rating, and not a single Republican voted for it in either the House or the Senate. And so politically, things are being divided in a very interesting way. And then I think it has big implications, obviously, for thinking about fixed income, for thinking about equity, thinking about thematic investing, run the gamut.
Right. Okay. So much there, and we will get to what it means for the market. I just want to make a little nod to, you mentioned that it wasn't just Republicans and it was actually Democrats. And I agree completely, because the last 40 years, if you think about it, think about very famous Democratic presidents like Clinton. Clinton actually went and cut spending. And it was with the Bob Rubin, right? That he,
the Bod Vigilantes,
right.
James Carville.
Yeah, and then we look at what happened with Obama. Everyone thinks that Obama was the spendthrift president. The reality is that this is one of my favorite things that I mentioned. If you look at discretionary federal government spending year over year, there was 3 years before the great financial crisis where it declined, 64, 65, and then the 94 with Clinton, or maybe 95. And then the only three out of 40 years where every other year it rose, and then we had 5 in a row with Obama. And so I just want to kind of drill this home, because and I love how you say that it is this policy which was, everyone believed it, in terms of the very famous Kenneth Rogoff book of This Time Is Different and how budgets deficits are bad. It culminated in Trump. And then it's almost been like a switch was flipped and we've gone completely the other way. Would you agree that it's gone from one side of the boat to the other?
100%. I called it a pivot point in my writing. And the only add I would make to your point, Kev, which is a great point, is that there have only been, however, 4 years in the last 40 where Democrats controlled both houses of Congress and the presidency. So while Clinton and Obama did exactly as you say, I do think the tendency of the Democratic Party with control of all levers of government is to be more activist and more progressive and more willing to spend on policy. And I think we're going to see that. And that's why, as I say, controlling and succeeding against COVID and unleashing a global economic boom and an economic boom in the United States is going to pay, I think, significant political dividends. And I believe that is completely the mindset that is in operation at 1600 Pennsylvania Avenue.
Now, one of the things that I worried about with Biden was that he was the old school. He was, because he had been in the government for so long, he still believed that all of these kind of, you have to balance the books, and they would fall for all the things that the Republicans had done to them previously in terms of trying to, cut spending when the Democrats are in power. And I've found that I've been surprised at how much he's transformed. Did you see the same transformation in Biden?
Yeah, and it's interesting because they always say you can't teach an old dog new tricks. And, Joe Biden's 78 years old, but he's certainly, I think, he's dialed down the temperature. He's taken, we're not having to pay attention. Isn't it just a blessing as a macro guy to not have to worry about every single word that comes out of the White House or every single tweet? For me, it's reduced my reading on that front by probably a third, which is a real wonderful thing. I do think Biden, I mean, look, I think he understands the hand he has been dealt with. And it was interesting, I don't know if you've seen it, but just in the last couple of days, he sat down with a number of historians, some of the leading historians in the United States, and talked with them for hours about where things are historically today in the sweep of history. And he gets it, that he has been presented with a big opportunity. In a way, I mean, obviously COVID is horrible for what it's done to and all the people that have passed away and the families that have suffered, and all the, here in New York City has been a very difficult place to be for much of the past year, but it is an opportunity to reset. And I think he gets that. And again, all the people there worked in Obama, and they understand that they did not do what they should have done, and they are getting a second chance. And, people, when they have a second chance, they typically tend to be pretty aggressive. And so everything I'm seeing is that. And he's not playing into the culture war stuff. And he's single-mindedly focused. And this has not been Joe Biden's history. Joe Biden's history is a guy who talks a lot, gets himself in trouble by talking too much, talks about stuff that's off the cuff. None of that. And so to me, it's admirable, and it's what the country needs right at this point in time, is to dial down the political temperature. I mean, we had our Capitol stormed by people.
Right.
So we need to dial down the political pressure. We need to deal with COVID, and we need to start dealing with inequality. And we are making headway in all those things. And we need to deal with climate. And I think that's next up on the agenda. And it needs to be done. And because that is the future. And by the way, other parts of the world, we're not in a world where the U.S. is the unipolar. My whole thesis is tripolar. Right. And so I'm a big believer that we have to look at what's happening outside of the United States. And what's happening outside of the United States is that the bulk of the climate clean energy activity is in China. And Europe is moving forward on its Green Deal and doing some very interesting things. And here in the United States, we've been in stuck going backwards for years. And we need to kind of catch up quick. And so to me, this is all very well and very good and needed, and should be something that, again, helps propel America. Because when you think, just a little bit of a side here, but when I think of the tripolar world, I think of Asia as the consuming center. It's going to be the center of consumption for the next several decades. I think of Europe, I think of the regulator, the rules-based power in tech and in climate. And when I think of the Americas, I struggle to kind of think of what is the rationale? What is the reason for being? What is going to be the thing for the Americas? There's very little between North and South America. There's not a whole lot going on between Canada and the United States. And so, there's a lot going on in terms of integrating Europe. All the Brexit and everything was very useful in terms of driving home the point that we want to be integrated. You don't hear anybody talking about leaving the European Union. You don't hear anybody talking about leaving the euro. All that stuff is gone. And in Asia, there's rapid integration around China as the leading, increasingly the consumer, not just the producer, the consumer. China is going to be the consumer. And all of Asia is starting to operate around that and around the renminbi as a currency, not the dollar. So there's rapid, dramatic change going on. And the U.S. needs to get in the game. And I think we're finally starting to do that.
Okay, so now lots to unpack there. One of the things that I kind of just first want to jumps out at me is that going back to this shift in Biden with his focus on spending and all the things that he's trying to tackle, there's obviously lots of market kind of ramifications to those. Why don't we talk about what you see as how this will impact the market going forward, and how in terms of it's affecting your portfolio, setups?
Perfect. So I believe we are in the midst of multiple regime changes across the major building blocks of the macro space. So let's start off with economics. I believe we are on the cusp of the biggest economic boom we have seen globally in 50 years. Global growth over 6%. Secondly, in terms of politics, we just touched on it, a pivot point and a sea change in U.S. politics. Third, policy. We're shifting away from pure reliance on monetary policy, not just here in the U.S., but globally, right? After 08, 09, elected politicians did virtually nothing. All the heavy lifting was done by the unelected central bankers. And to the effect that we saw where markets boomed and nobody else did particularly well, and populism reared itself all throughout Europe and the United States. And fourth, in markets, we are entering, or have entered, in my view, a bear market for U.S. Treasuries. The last bear market in the U.S. Treasury market ended 40 plus years ago in the early 1980s. So for me, most of the people investing today have never experienced the environment in which we are investing. And it has big ramifications for the quant side of the house and the quant side of the investing world, because the models don't work, because what we're doing hasn't happened, and so you can't really model it. And you saw that last year with the quant funds suffering significant underperformance. And so to me, you have a whole host of things. And now in the near term, that leads to significant, I think, asset allocation changes, namely what I called the great rotation, which was a great rotation trade. And I've dropped the term trade because I think it's going to be secular, namely the shift away from growth and away from technology, which has been the leaders since 08 and 09, since the bottom, which meant that the U.S. was the leader global equity-wise since the bottom because it was the market with the biggest tech weight.
Right.
And now you see, and I wrote about this some 6 months ago, rising rates and vaccinations would be kryptonite for big tech.
Okay.
I mean, Print was saying that, probably 5 or 6 months ago.
Why don't you explain to us why that is?
Well, I mean, the vaccinations mean the whole work from home thesis goes away. Right. And you've just, and now every day is almost complete with, various prognosticators recalibrating the percentage of people that are going to go back to the office. I just saw something the other day. So work from home gave tech a huge boost, probably accelerated adoption of certain things. I don't doubt that at all, but gave all those big companies major boosts in economic activity. But guess what? They all peaked last fall. Right? If you look at Zoom, you look at any of the work, Peloton, you look at any of the work from home winners, they peaked in September, October, November. Big, the FANGs peaked versus the S&P 6 months ago. So that the vaccinations and rising rates, obviously these are long duration growth assets that are valued off of the cash flows, where higher interest rates lead to lower valuations. And so you've seen that play out in the last, more aggressively, obviously, with NASDAQ in the last month or two. But it's actually, as I said, most of the tech space peaked versus the broad market 6 months ago. And I coined the phrase from domination to disruption, right? So where you want to be in the tech space is not in the dominant FANG names, but in the disruptors and in the innovators. Okay. And this is something that, is playing out at the moment. And is one of the things I'm struggling with, frankly, is, are these thematic, the innovators, the ARCs, et cetera, are they going to be valued as they seem to be in the last couple of weeks, in the last month or so, as levered plays on tech, on the big cap tech? Or is there going to be a differentiation? Is the market going to be able to differentiate between big tech and innovative, disruptive tech? And that's something we could continue to talk about. But to get back to the point of rotation, so now you're talking about a massive shift from growth and technology into value and cyclicals. And we've seen this play out with interest rates, yield curve steepening, financials doing well, energy doing well, materials doing well, small caps doing well, non-U.S. outperforming the U.S., Europe doing well, better than the U.S., even with all the disaster of their vaccination process, still doing better, in part because the production side of the European economy is on fire. in part because Asia recovered from COVID first. And so the demand is coming through. Asian demand is being met by European production, which is one of the reasons why the U.S. is not going to find the Europeans to be super willing allies to do whatever the U.S. wants them to do in regards to China. Why? Because China is now a bigger export market for Europe than the United States is. And at the end of the day, it's who pays the bills are people who one needs to listen to. So to me, the way I expressed it, Kev, is that we are a global economic boom in these regime changes leads to a great rotation, which creates a golden age for asset allocation.
Okay.
And this golden age for asset allocation is great for guys like you and me because, to be honest, we've been kind of on the shelf for the last decade. You didn't need a global guy for the last decade. You didn't need a multi-asset guy for the last decade. All you needed was a U.S. tech guy and maybe if you were a fixed income guy, a risk parity strategy.
Right.
And so one of the things that's really interesting is that, and when you have these switches in the market and these sea changes, all the money that has been loaded into 60-40 balanced and risk parity over the last 10 years is now going to go somewhere else. Risk parity in the United States returned 10% per annum in the 2010 to 2020 period. The forward projections by experts forward for 5, 7, 10 years is roughly 1% per annum return for US 60-40.
Jay, let me interrupt there and just ask you to explain what risk parity is and why it did so well over the last decade.
Well, it's basically, I'm no expert. You could probably do a better job of defining risk parity
I'm going to let you do it, though.
No, come on, over to you. No, basically, it's guys who balance between stocks and bonds and run volatility-based strategies as far as how they weight the different things and have benefited, therefore, from twin bull markets, twin engines, where, as I said, you have been in a bull market for bonds for decades, since the 80s. Effectively, with very little interruption, the taper tantrum and blah, blah, blah. But reality is rates have been going straight down for 40 years. Right. And now there's turned and they're going back up. We can debate about how far back up they're going to go over what time period, but I think the turn has been made. And then we've had for the most part, notwithstanding some very vicious and short-term bear markets, we've had effectively a bull market in stocks. So those strategies, playing both, but with relatively low vol because they're balancing the two off, have done great, and therefore they took in a lot of money.
Right.
And now that money is faced with the reality of that return stream is going to look very, very different. Bonds, as another famous investor, Lee Cooperman, formerly of Goldman Sachs and then of Omega, and a great friend of Barton and Byron's, by the way, call it treasuries are return-free risk assets.
Right.
As opposed to risk-free return assets, which is what they are known as in the lexicon of investing. They're supposedly risk-free.
So the 60-40 that traditionally has done so well because not only has both of them been in a bull market, both stocks and bonds, but they've also been negatively correlated, meaning that when stocks got into trouble, your bond saved you because it actually went up. I've argued for a while that instead of being a ballast, bonds are going to become an anchor that actually around your portfolio.
100%.
But I just wanted to touch base with, given your attitude that you share very similar worries about the bond market in terms on a secular basis as me. What are you doing in terms of your portfolio for that 40% of a traditional investor? What would you suggest they do?
Yeah, that's a great question. And so my portfolios have been benchmarked roughly, or I used kind of as a benchmark, 50% ACWI, so all country world global equities, 30% Barclays Ag, so U.S. bonds, 10% Barclays Global Ag, so global bonds, and 10% commodities referenced by the Goldman Sachs Commodity Index, which is fairly heavily weighted to oil. And now, where am I now? I'm significantly overweight equities.
Okay.
And underweight the U.S. and within the U.S. virtually out completely from the big cap tech. Very heavy in financials, very heavy in energy, heavy in small caps, heavy in value, all through ETFs. I focus primarily on ETFs. So my portfolio is roughly the model portfolio, which I now offer to clients, is based on my own investing. So I continue to manage my own capital as I have consistently for the last 15 plus years. That is the foundation. Based off that is this model portfolio delivery service I offer, which incorporates about 20 to 25 ETFs at any one point in time, heavily overweight equities, heavily underweight the U.S., overweight non-U.S., primarily Europe and Japan for that value cyclical tilt. Not really super enthused about emerging market equity. I don't think people who talk about emerging market equity as being very ripe for opportunity because commodities are going to boom need to look at what the emerging market equity index looks like today versus what it looked like 10 or 15 years ago. They're completely different. Tech is a huge weighting. China is a huge weighting. So you're basically buying tech if you're buying EEM or something like that. I do think emerging market tech is interesting, and there are ETFs to play that. But emerging markets by itself are something that I think I'm not as enthused. I'm more enthused about the non-U.S. developed markets.
So, Jay, did you just take basically the traditional bond portion and just fill it with more equities? Is that in?
Well, I was gonna get there.
I'm sorry. I didn't mean to interrupt.
Yeah. No, not that. I mean, it's a legitimate question because it sounded like that. Yeah. No, I still have, my fixed income position is roughly half the benchmark.
Okay.
So 20% versus 40%, and it's primarily in preferreds. I still like preferreds. They offer a pretty good yield and very low volatility. I like local currency emerging market debt. I don't think the dollar is going to strengthen. I think it's going to weaken. And you get pretty decent yield and spread there. And I like high yield in the U.S. I think, again, high yield is performing much better than investment grade. Investment grade got way overheated. So that's where my fixed income is. And where the difference is, Kev, is in two places. One is kind of in commodities, quite heavy in various parts of the commodity space. And then thematic. Investing thematically, which is something I've been very focused on, have written my last two monthlies on that particular topic. I just produced my March monthly today, went out today, and the title is Investing Thematically in the Tripolar World. And so I do believe that one of the things that really helped me in the last year was to add a health component to my global risk nexus. Remember, it looked at economics, politics, policy, and markets. A year ago, I added a health component because everything was going to be driven by COVID. And that health component allowed me to understand COVID speed, right? The speed of the spread, the speed of the policy response, which was unprecedented, the speed of the market reaction to the policy response, likewise unprecedented, the speed of science in terms of developing a vaccine in 1/10 of the time it took historically, the speed of delivery, which is where it's kind of fallen down a little bit, the vaccination process, the rollout, the speed of the fall, namely the fall in hospitalizations in the UK and the US fell almost 80% within a month. And now I have basically taken this argument and said that COVID speed of science model, global intellectual and financial capital focused on a single issue leading to unprecedented results is a game changer and can be spread and broken out. I said it broke out into other global challenges like climate, like cyber, like fintech and crypto, things that are global issues that have both global intellectual and financial capital being applied to them. And I think we're going to see similar unprecedented results as a result of this model now being made visible and being applied elsewhere. And thematic investing is the way particularly for global macro, because thematic investing is effectively global macro investing. It's top down. It uses economics, politics, and policy as part of the process. And so global macro investors actually should be all over the thematic investing approach. And ideally, I even argue in my piece that, because global macro has been kind of a backwater for the last number of years, as we talked about, right? It's been all U.S. and all U.S. equity, could be the revitalization of the global macro space. And I'll tell you how far down, how far off the global macro space has become is that I read the other day that Soros Fund Management, George Soros's fund management company, Soros, the guy that broke the pound, the quintessential macro investor, has less than 10% of his portfolio invested in global macro strategies. So that's where global macro is. And so I think there's a tremendous opportunity in things like clean energy, in electric vehicles, in batteries, in carbon. I think there's a tremendous opportunity in cyber, in gaming, in genomics. There's significant opportunities in the melding of traditional banking, fintech, and crypto. And what's so interesting, Kev, is that the way I've been able to do this in the last couple of months is pair trade almost old and new. So old energy, think about the big oil majors in the U.S., and clean energy, think about batteries, or think about solar, or think about carbon. And then similarly in the financials, old financials like XLF in the U.S., the financial ETF, and fintech or crypto.
Right.
And by doing so, what I've realized is that I've been able to participate in the value play, right, which I'm a big believer in, that rotation. So that's my value piece, is in XLF, XLE,
right,
things of that nature. And then my thematic play is in things like GBTC and the Bitcoin, the Grayscale Trust to give you access to Bitcoin, in things like KRBN, which is the carbon,
right,
or ICON, which is the clean energy, and ARC in the innovation, ARC-F in ARC for fintech. So you balance the two out, and you dampen. It's almost like the risk parity in 60-40,
right.
But within the equity space, playing off the high beta thematic stuff, because it is high beta. It's actually been, frankly, to be honest, more high beta than I thought it was going to be over the last month or so. They've been hammered, and then play off with the XLE and XLF, which have been rock stars. XLE was up 40% in a month prior to the pullback here in the last week or so. 40% in a month. And by the way, yields 5% in an environment where the 10-year yields 1.5%, 1.6%. So there are, and the last thing I'll say, and then I'll stop, is that I've been very impressed, and I wonder if you have been as well, that as to the way the market has popped all these little bubbles over the last 6 months. We have completely taken out the bubble of the FANG stocks.
Right.
We have taken out the bubble of GameStop and all these other kind of Robinhood stuff. We have taken out the bubble in poor sell-side consensus calls about the 10-year ending 2021 yielding 1.2%, which is what it was, in December. Now it's 1.7%.
Right.
We've done that, Kev, with the S&P less than 2% off its all-time highs.
Yeah.
And we've taken out the bubble completely in all this thematic stuff and ARC stuff in crypto. People keep talking about the bubble, and I'm sitting there, and this is the benefit of everything I do being based off my own portfolio. I own everything I'm talking about. I know, believe me, what it's done. And I hear people talking about bubble, and I'm like, what are you talking about? GBTC is 40% below its high.
Right.
ARC is 30% off its high. It went from 160 to 110 in a month.
Yeah.
I mean, ICLN, the LIT, the battery ETF, these things are all down 20% or more. So I think we've done an admirable job in terms of being able to have the breadth of the market. With the value stuff working, has shown you that the market is now a two-sided market. It's a twin-engine market. It's not just a tech market. It's a market that now has value and other things working in it, small caps as well as large caps. And so I think we have reset the fixed income side. Everybody knows there's going to be some inflation numbers. You have to live under a rock on Mars to not understand that inflation numbers are going to be 3% or 4% these next couple of months. the Fed has done an admirable job, as I expressed it the other day. I would much rather have a data-dependent Fed than a dot-driven Fed. And that's where we're at. I think that's great. We know what data the Fed is looking at, and that's what we'll look at ourselves. Same thing. The market wants to test that, fine. But I don't think we're going to have to worry about the market running over the Fed or inflation becoming unhinged. I think all that stuff is just way off the mark. And so to me, we're in a very interesting position. We're about to start the reopening. We're about to start a economic boom. And we have a market that has done an admirable job of pricking every little bubble that's out there. Am I right?
Yeah, I listen, I've been arguing this for a long time. I call it, I have a rolling bubble framework. And I've noticed this for a long time, that what happens is you get these 6 months or a year of everyone piling into the asset, right, and then it gets pricked and we go on to the next thing. And I completely agree. And I think it's shocking, actually, even today. Today was a terrible day for a lot of stocks, as there was some hedge fund blew up, and yet the S&P screamed to new highs or pretty close to new highs. So, and you're absolutely right as well that if you would have said that ARK was going to get clipped for whatever they've gotten clipped for 30%, and then you said where's the S&P, I think very few people would have said that it would be here.
Yeah, all-time high.
Yeah. so I completely agree with you. So do you not worry though about the bond market eventually giving, a competition to the stock market? Like, I know that's one concern that a lot of people seem to have.
I just don't get it. I don't really get. We're going to have earnings growth of, 25% this year, and probably very strong earnings growth next year. We're going to have banks being able to pay dividends again. We're going to have buybacks again. And yet I'm going to want to go and buy the bond market because it yields 1.8%.
Yeah.
I mean, I can understand the bond guys being a little happy because now there's a roll down capacity that they can make money a little bit, playing back and forth within the fixed income yield curve.
Right.
But as an equity guy, I mean, like I said before, XLE has a 5% yield.
Yeah. So
why would I have any interest whatsoever in buying the 10-year at 1.8%? I think bonds, to me, like I said, I've allocated roughly half my bond position to thematics and to the commodity side, real asset side. I don't think inflation is going to run away. I think the core PCE that the Fed looks at is pretty sticky. It may go up a little bit. We should be happy with that. Right? Higher rates mean the COVID is being brought under control, means the economy is recovering, means consumer confidence is coming back. Those are all good things. Getting off the zero bound is a good thing. Having inflation as opposed to risk of deflation is a good thing, particularly given how much debt everybody has. And I don't think that, that rates going from 0.9 to 1.9. I mean, I've had a 2% 10-year target since November. And I continue to think that's pretty reasonable. And I think equities can do fine in that environment. And remember, Kev, the other thing is that the Treasury market looks good yield-wise relative to Europe, relative to Japan. On a hedge basis, it's the most attractive it's been for Japanese and Euro-based investors in about 4 or 5 years. And so to me, that's I think you're going to see offshore buyers. You're probably not going to see as much buying by banks here in the U.S., but that's fine. I don't think that's a huge problem. And it's a matter of degree. I mean, the thing that I'm really wrestling with, here's my question right now, and I mentioned this in my monthly. Are these thematics going to continue to trade as levered plays on the NASDAQ? Or is this paradigm shift in this move to innovation that I believe is going to be mirrored from COVID science to climate and cyber, et cetera, does that bring in longer-term capital like the asset owner community, the pension fund community, all the really smart long-term money guys you have up in Canada? Are they going to come in and start participating in some of these themes? Because themes are by definition attractive to those folks because they're long-term. They play out over long term.
Right.
They line up very well with the liability side. So my question is, because if you're going to get the same kind of arc down 30% in a space of 5 weeks, you can't really have too much of that in your portfolio.
Right.
Otherwise, you're going to get blown up. So there's a lot of sizing and positioning. And so to me, it's a question of, does thematic stay high beta? Because I do believe thematic is a great opportunity for the macro side of the house. And I do think it's where you can generate alpha. Most of it's off benchmark. Most of it is cuts across sector industries, not part of the indices. And so I think there's a lot of opportunity there. But if it's going to be that volatile, you can't have too much of it. But on the other hand, if you do have the asset owner pension fund community come in and start to participate, they dampen the volatility and you get something akin to a sustainable, longer term move up as these different innovation segments start to manifest themselves in really being successful in making money.
Right. So for now, you just continue with the barbell approach. The value, the rotation, which you think is a secular theme that's going to continue, along with your new thematic kind of the new innovation that is also going to continue.
Yes, and you can pair it with the old and new, like I talked about a while ago, or you can also participate in shuffle your thematic deck, as I've done over the last month or two, reducing a little bit of the super volatile ARC type stuff and adding things like infrastructure or carbon. Which are more longer term plays that don't have the same volatility attached to them. ARC became kind of the poster child, so everybody hopped on it, just as you said, and now they've hopped off it, and we'll see where it all shakes out. But to me, there's that's what's so nice about the thematic. The challenge is, though, again, Kev, is how do you integrate that into your process, right? I mean, because I'm not going to be an expert on life science or genomics or cyber. I'm barely an expert in tying my shoes every morning.
You and me both, Jay. You and me both. Well, you know what? Actually, I have a lot of problems with the COVID 30 that I put on, and that's why I'm having trouble tying my shoes.
Yeah, bending over, right? Yeah, exactly. I can't get down on my shoes anymore.
So listen, before we leave you, we promised that we were going to talk a little bit about your climbing. Because you're you mentioned that you went climbing with Barton.
With Barton.
And is that what got you the bug? Is that because I know you and I have spoken offline about your climbing.
Yeah.
Is that so? It started there. Why don't you walk us through what you recently, was it this year that you completed your...
Oh, no. That was a buddy. I went with a friend. That
was not you. Okay, so tell the whole story. Tell us the whole story.
Yeah, no. Bart, I think that was kind of the beginning of the big mountains.
Right.
And I was always, in those days, you're working for Morgan Stanley. I was traveling all the time. I was a global strategist. I've worked in over 50 countries around the world. And, I liked it those days to take a vacation and completely rest my mind and exercise my body.
Right.
Because the rest of the time I was exercising my mind and not really having time to exercise my body. And so I would go on these big trips, 2 or 3 weeks at a time, and no newspaper, no TV, no nothing. I went trekking in Nepal. I went climbing in Mongolia. I had one trip. I'll tell you one trip to encapsulate all of these because I don't want to bore your audience. But I did go 2,500 miles, Kev, to expunge the sins of my present life. Okay? And that's because at the time I was a near 40-year-old bachelor in New York City, and I did have a few sins. Okay. So that was kind of like Byron's comment about, what he wants to be traveling in. And what that meant, to unpack that a little bit, is there's a mountain in Tibet, in Western Tibet, called Mount Kailash. And it's sacred to Hindus and Buddhists. It's a pilgrimage site. And the story was that if you circumambulate it, so you don't climb it, you circle it, because climbing it, it's sacred at the top. Okay. You circumambulate the sacred mountain, all the sins of your present life are forgiven. And I'm like, sign me up for that. And so I got onto a trip with a group of people, men and women, and we left. We flew into Beijing and then flew to Urumqi, which is now all in the news for the Uyghur issues. Right. But all through that Western China, we basically picked up 7 Toyota Land Cruisers in a 5-ton supply truck, which had our water and our gas. Okay. And we off-roaded for 1,700 miles from Kashgar all the way through Western Tibet to the Sacred Mountain, which was 3 days, 32 miles to circumambulate it, between 14,000 and 19,000 feet in elevation.
Oh, that's actually really high. People are like,
yeah, no, 19,000. So the story, the story of that circumambulation was we got caught in a snowstorm on one of those high passes.
Yeah.
And we had to, kind of quickly dive into a tent and, hopefully make it through the next day. And we did. And I woke up, and I'm blind as a bat. Besides being able to barely tie my shoes, I'm practically blind. So I wear contacts. And my contacts, when I woke up that next morning, were frozen in my case.
Okay.
And I had glasses, but I did not have prescription sunglasses.
Okay.
And so you can imagine we had a storm. It was snow.
Yeah.
There's nothing but white and sun.
Oh.
And my glasses with no sunglasses. And I am like, and my eyes are sorry, I'm in pain. I can barely see. I'm like, I've got my contact case under my armpit, trying to warm it up so it melts so I can put my contact lenses in. I'm telling you, I got back to the end of that trip after the 32 miles, there was some horrible little guest house that we all congregated in, because by the end of it, Kev, the whole crew was all strung out, right? Everybody was on their own journey to hell, and trying to make it through. Every bone in my body hurt. And at the end of that 32
and the important
miles.
thing, were you forgiven for all your sins?
Well, I darn well hope so, because like I said, it was painful. I mean, it was hard. It was really hard. So
one last thing in terms of your pal, you finish it off. I did not know this, but they're on the East Coast, there's a whole bunch of mountains, and your pal climbed how many different mountains?
Yes. Okay, yeah. So New Hampshire, there's 48 4,000-foot mountains.
Okay, which is not that. It's not that it's not small, but it's compared to being at 20,000, elevation.
Yeah, it's very different.
Yeah.
Well, the thing is that those 4,000-foot mountains in New Hampshire, you do 2,000 or 3,000 feet of elevation.
Right.
It's all about the elevation.
But he climbed them all.
He's done them all, and he's a guy in his early 60s, late 50s, early 60s. And so impressive. And so I'm a good buddy, and I'm like, hey, I want to come with you to celebrate your climbing the 48th. And of course, he picked the toughest one, and it was just an endless 10-hour hike up and back. My shoes, my hiking shoes, fell apart on me at the end. I had to throw them in the dumpster. It was like, you know what? I'm starting to think that those days are over for me, and it's more for my kids at this point, right?
Well,
let the kids, let the 18-year-old do it.
The good news is you've been forgiven for all your sins. Okay, so Jay,
yes, exactly.
It's been a pleasure having you on. Why don't you tell people about your service, where they can find you, and learn more about it?
Oh, great. Yeah, that'll be great. So the firm name is TPW Advisory. The website is easy to find at Pelosky.com, so PELOSKY.com. And we offer essentially a boutique service, so bespoke portfolio strategy and asset allocation advice. We do white label research for IRAs and others, family offices, et cetera. And we offer that model portfolio delivery service, which I mentioned earlier, which I think a lot of folks, so far, the interest there and the response there has been pretty good. There's a lot of people who are, interested in global multi-asset, as we talked about, after years of being kind of in the wilderness. It's a strategy that folks are increasingly interested in as they see the outperformance of the non-U.S. markets, and they understand the opportunity set for value and cyclicals in places like Europe and Japan. And then there's also that thematic opportunity set I spoke of, which I integrate into that global multi-asset portfolio. So those are the services. I write once a week. I have my Friday musings, which people like a lot. It's typically less than 1,000 words, so it can be read in 3 or 4 minutes, and it's a distillation of all my thinking of the week. And then I do a monthly write-up, which is much more kind of evolved and involved, 2,500 words or so, and with all sorts of charts and pictures. and all of that's available. You can reach out to me. The model portfolio delivery service obviously is a fee for service, which depends on the assets under advisement. But I am open for business, excited to work with folks who want to have a portfolio that provides them exposure to the world and to the different asset classes, as well as to the themes of innovation. With somebody like myself who's been in the business for 30 years, has worked in 50 countries, and has plenty of stories.
Well, thank you so much.
I'll stop there.
Yeah, thank you very much for coming on, Jay. I really enjoyed this. Next time we'll have to talk some hockey.
Excellent.
Okay.
All right. Go Bruins. Thanks, Kev.
Thanks. Take care.
Bye-bye.
Okay, it's our pleasure to welcome back to this show one of our first early guests, Barton Wang from... you got a new project out there, Barton, and when I found out about it, I was like, we got to get you back on the show and give you a chance to talk about it. Welcome back.
Hey, Kev. Thank you for having me back on. This is perfect timing. Very exciting.
It is very exciting, and you were one of the first to really jump in and kind of look into the liquidity of both the Federal Reserve, the Treasury, and the agencies, meaning Fannie and Freddie, in terms of interpreting what that means to the market. And you went and it started off as a side project, and I was amazed at the level of sophistication that a side project like that, does. But I guess that's what happens when you're an engineer. And you went about doing that, and now you've turned it into a newsletter, and we're going to talk about that at the end. But why don't you walk us through your evolution about how you came about, determining that this was something important and something that offered an edge for investors?
Yeah. Well, first of all, also, I'm very happy that I don't have to talk about coronavirus anymore.
Yeah, that's right. For a little while, you were a coronavirus expert on Twitter.
Right. So basically, a few years back, in the U.S. and basically across the world, we implemented something called Basel III to the major banks. And that had a very interesting side effect that started to become the driving factor, one of the driving factors that moved the equity market a lot. And I was really intrigued about how the market was moved by all the different kind of forces around 2018 after the Armageddon crisis. And what really caught my eye was this monthly oscillation. Every first half of the month, the market will rally and then will fall back to a 12 for the second half. And that turned out to be perfectly aligned with Federal Reserve's QT cash flow or schedule. So that got me really intrigued in this, and I made some money off it because if you can predict this weeks ahead, then it's quite profitable. What's really interesting and exciting right now is basically since mid-February, we're falling back into that kind of action right now in the market. And initially, this is kind of very mysterious to me as well, because we're in this massive QE regime.
Right.
And we shouldn't be affected by the Fed liquidity flow because banks are swimming in bank reserve right now. They're 2 or 3 trillions money or more being printed in the last 12 months, right?
Yeah.
So,
why don't we actually, Barton, before we go on there, why don't we step back and talk about QT, QE, what it is, how it works, and, what you saw. Like, walk us back to 2018. You talked about, you saw moves in the stock market, but it was based upon moves by the Federal Reserve. Why don't you just flesh that out a little for us?
Right. So if you look at what happened in 2018 for the equity market, that was the time when the Federal Reserve first decided to shrink their balance sheet. And they did 2 things. They start to let the U.S. Treasury bond they hold to expire without rolling them into new Treasury bonds.
Right.
And they let their mortgage-backed security to roll off their balance sheet as well. And what happened was the U.S. Treasury always rolled off at the end of the month. So the last day of the month or the first day of the beginning of the month if the last day of the month falls on the weekend. And the mortgage-backed security rolls off also at the second half of the month, driven by the Freddie and Fannie and Ginnie Mae's schedule. And that caused some kind of a liquidity crunch during those weeks. And the market just make very large moves during those period, 5% or to 10% crashes or sell-offs during that time. And so afterwards, it immediately recovers.
Right. So you notice that the periods of quantitative tightening, which is the opposite of quantitative easing, the Fed buys bonds. Quantitative tightening, the Fed either sells bonds or lets them mature, which is, I guess, that last little bit is a little bit people often mistake and don't understand or miss that portion of it. So periods of quantitative tightening cause the stock market, which everyone, all the economic eggheads tell me that it shouldn't be the case, but you found that it caused the stock market to sell off.
Right. At least the correlation is too good to be a coincidence for months.
So you started following this, and you created quite elaborate sheets where you would go and track each, maturing bond, all of the Fannie Mae and the Freddie Mac. And I'll be honest, this started, I remember you and I talking early because I had noticed the opposite, the quantitative easing in the moments after the great financial crisis. I noticed that it caused the stock market to go up. And I did my own analysis back then, and I just, superficially looked at the days that the Fed was buying bonds, and then I looked at the stock market returns, and sure enough that they were coincided. Again, everyone tells me that it shouldn't be, but it is. So I refuse to this day. I still think that it is, and I don't buy the argument that the Fed doesn't actually affect stock market prices. And actually, why don't we talk about that? Because a lot of people will tell me that if it does affect stock market prices, it's because of a kind of let us just say a confidence effect. It's a function of the participants are more excited because they see the Fed doing this. What's your take on it? Is it a real effect or not?
I think it's real, but I think the transmission mechanism is quite complex. So many people probably don't realize it's actually happening. What's happening behind the scenes? So, by the way, Kev, I got into this area because I read all your posts about how QE was affecting the stock market like 5-7 years ago. That's a long time ago.
You were an early tourist subscriber, and you actually read that and said, "Hey, wait, I can do this a lot better than this punk."
And I'm going to do it on my own spreadsheet to track exactly what Fed has been doing.
You were like Ronald Reagan, trust but verify. You believed me, but you had to see it for yourself. I'll tell you one thing that I've kind of passed along to people. I met a fellow that worked at a hedge fund, and this was a hedge fund overseas, and they used to go and they used to deal with the Japanese postal, the pension plan, the largest pension plan in the world. And he told me that they used to watch for the quantitative easing programs, meaning the Bank of Japan buying the bonds, because it would be like this. The Bank of Japan would buy the bonds, and they would buy it from the post office. The post office would sell the bonds, and then the next day they would give the order to these guys to go buy risk assets. And so he knew, he literally sat there, and they were ready for the buy order. They were like, okay, here they come. It's going to be this big. So I don't buy that it's not as direct as everyone thinks it is.
Yeah, I can explain the dynamic a little bit more in detail here.
Okay,
so
go ahead.
There are a couple of concrete pathways for the QE to affect the market. So one, as you said, was the available of liquidity, and in this form is more of how much liquidity is available to the shadow banking market, like the repo market, because hedge fund, for example, use repo market to get cheap financing for their total return swaps or the portfolio swap. These are the products that a hedge fund can use to gain leverage.
Right.
And for them, it's like a future, right? They don't have to put up the capital for buying the entire 2x, 3x dollars of stocks that they're interested in. They can it's like a future contract for hedge fund from the dealer brokers. So the availability, the cost of these are tied to QE for one. Also, QE directly affects, so that's number one. Number two, QE directly affects the price of treasury bond for sure, and mortgage-backed securities, and sometimes stocks gets very strong correlation with these assets classes, and then you will see the stock market move. And number three, probably very important in 2018 and 19, was the QE sometimes affects the foreign exchange market a lot.
Okay.
And that's a very acute influence. It often happens like the night when QE or QT was done. And there was, throughout 2018 and 19, actually, the US dollar versus euro exchange rate was tracked to QT and QE schedule even better than the equity market for a much longer period of time.
Okay. So that was actually a better way to go express your view. Like you noticed this pattern, you were better off going and taking trades in the currency market as opposed to the stock market.
Right. And then the currency often gets into a strong correlation with the stock market as well, and that moves the stock market accordingly.
Right. Okay, so that's a great explanation. So let's get to the charts that you brought along. And the first one here says, when the market starts to oscillate nicely with a calendar month, I pay attention. So tell me what you're seeing today.
So if you look at this chart, you can see that starting from the mid-January, the market has been basically selling off in the second half of the month and rallying in the first half of the month, and just rinse and repeat into March. And usually there are a couple of explanations for something like this, right? There's this option expiration cycle every month, and people rolling their option positions, and that drives also the Vanna effect that Jam talked about a few months ago.
Right.
Drives the index levels in this way. It's kind of a rally in the first half of the month before the option expiration. VIX expiration is another thing that kind of crashed the implied volatility of options, and also drive up the price if there's a lot of color being bought by the market as a whole.
Right.
The other thing is Fed. If we see something like this, but Fed and Treasury, their action is more aligned with the calendars and the option expiration schedule, which kind of shift back and forth 1 week or back, because it's not really expiring on the 15th of the month usually. So every time this strong oscillation happens, it means several factors, maybe the option, the Fed action, something are just working together and makes this a really pronounced price action that you can see on the index.
Okay, so Barton, you've noticed that the market is going on almost a calendar, and you mentioned that some of it has to do with the options, and no doubt we understand that. But you're arguing that a lot more of it has to do with the Fed. But the interesting thing is that right now, the quantitative, the Fed's actions should actually be causing the stock market to go up instead of down. So how do you reconcile what we're seeing in the market with what you know to be happening with the Fed and the cash flows?
Right. That was a puzzle that I was confused for quite a few weeks in February as well. And explanation or theory I came up with, this is only a theory because I cannot look at everybody's book and order flow. The theory I came up with, and so far has been working pretty well, is called stimulus indigestion and crowding out effect, which I call it psycho.
I like it. You got Patrick Bateman there on the slide, like with the picture. American Psycho.
American Psycho.
I like it. You got all the acronyms going. Okay, so why don't you walk us through what that means?
So if now we look at, for example, SPX price action in the past 2 months, and overlay on top of that the cash flow from the Federal Reserve, who was doing QE and a little bit of QT because the mortgage-backed security settlement is kind of a tricky issue. So let me explain first here. On this chart on the top, you see is the Fed cash flow. Blue means is money coming out of Fed, so it's bullish to the first order, to the market. And then red are the money flowing back to Fed. And one of the reasons why there's money flowing back is because when Fed is doing their $40 billion per month QE on the mortgage-backed security, what's actually happening is that Fed is buying around $120 billion worth of mortgage-backed security, which is settled in the first half of the month. And then in the second half of the month, Freddie, Fannie, Ginnie, all of them will pay $80 billion back to the Fed as part of the prepayment because people are doing refinancing.
I get it. There's a problem with cash flows.
Right.
It's almost like the whole conundrum with the TGA.
Right. It's 3 steps forward and 2 steps back every month.
Okay. I get it. And so now, how do you play that? What does that mean?
Oh, it's not done yet. This is just
I'm sorry.
first part.
Okay. Walk us through the next steps.
So the next part, that's also why this all of a sudden becomes an issue, is that Freddie and Fannie, these two big agencies that create mortgage-backed securities, they used to have their cash flow misaligned. Freddie used to do their prepayment on the 15th, and Fannie do their prepayment on the 25th. But because of the unified mortgage-backed security thing was pushed out last year, now half of the Freddie's cash flow is happening on 25th as well. So you have this gigantic cash flow out of the GSE, meaning the Fannie and Freddie, on the 15th, on the order of 120 to 140 billion every single 25th of the month.
It's funny we're taping this on the 26th, just yesterday.
Yes, it happened yesterday. And if you look at the Fed balance sheet, there's one category under other, and that's where the Fannie and Freddie's account sits at, and you will see that they have these 80 billion, 120 billion jump last week because it ends on Wednesdays, and then that was 24th. And then next week, you're going to see that number deflate by $120 billion because they paid out.
Okay. And so now, how do you play that? What do you think that means?
Oh, sorry, there's a third party. Yeah, sorry.
I keep doing this. I keep going, trying to go ahead, Barton, and you keep saying that we got to get it all. Okay, so you got the first two parts. What's the third?
The third is the Treasury.
Okay.
Treasury is pumping a lot of money into the market, and that's causing an indigestion problem.
Now, in terms of the indigestion problem, how would that be negative for the market?
So this is counterintuitive, right? Because you would think that more stimulus, more spending from the government should be positive for the market. And this should be increasing the M2, increasing inflation, increasing the earning cash flow of the company. So everything should be positive, right? And that's, in fact, was how the market has operated in the past 12, 13 months, ever since forever. Ever since the start of history, it has operated this way.
Right.
But if you look at this chart carefully, when I intentionally put the treasury flow, when the cash is flowing out of treasury, I put them as red color. You see that it was operating in this old or traditional way of thinking up until February 15th. Okay. And afterwards, every time there's a large amount of $30 billion and above amount of money coming out of Treasury, especially from the TGA account to the bank's account, we suffer a crash.
Okay.
A sell-off or something. And this is happening, I think, again, because of the Basel III, because of the thing that everybody have heard too many times in the past months, the supplementary leverage ratio, SLR rules on the banks. Okay. And I believe that ceiling was getting really close around February 15th. And that was a time we started to hear a lot of chatter from banks demanding for that exemption to be extended for another 6 months or a year.
Okay.
And ever since, the market has been actually punished by too much cash flowing into banks' balance sheet, which will crowd out other assets they have, and probably limiting the leverage hedge fund can get, and causing people to degrowth their books.
Interesting. Okay, so let's walk back and let's just talk about the SLR because you mentioned it. Why don't you tell people what it is, when it came to be, and then what the issue was this past month with it?
Right. So SLR is a very simple idea. It was proposed actually back in 2010 when Basel III was first negotiated and agreed upon, but it's only put into place in 2018. Basically, it says that the bank's balance sheet, the big bank's balance sheet, cannot exceed 20 times their tier one capital, basically their cash, the stocks, the common stocks they have.
Okay.
And all that. And this constraint was never designed to be a binding constraint. It was supposed to just limit the leverage of big banks to be less than 20 so that we don't have a repeat of 2008, 2009 financial crisis when Lehman had a huge leverage ratio, I think 33 or 35 at the time.
Okay.
But nobody was considering the scenario right now we're having where all the central banks are doing QE for extended period of time, such that the balance sheet growth from these big banks actually exceeds the capital, tier one capital they have in these banks. And we unfortunately are triggering this upper limit from time to time and causing market to behave in very strange ways.
Okay, and and so the SLR was it was actually relaxed on the COVID crisis. If I got this correct, they relaxed it because they wanted the banks to be able to buy bonds and not to have to put up the capital. And it was scheduled to come off March 31st. And
That's right.
And there was a lot of speculation in the market that due to the fact that the banks needed this, that there wouldn't actually be, that they would be extended, meaning the exemption would be extended. And much to many people's surprise, the Fed did not go ahead and extend it, meaning that now all of a sudden the banks actually have to put up the old amount of capital based upon these trades as of going forward on March 31st. Have I got that correct?
That's exactly right.
Okay, so I have a question for you, Barton. What do you think the Fed, and I'm assuming it is the Fed that made that decision, if I remember correct, I think it is. What do you think the Fed is doing in terms of what is their goal in not extending that? Walk us through what you think's happening at the Fed with that decision-making process.
Okay, this is completely hypothetical, just my way of guessing what Fed has came to arrive at this decision, why they let SLR exemption to expire. I think, first of all, Fed wants to accumulate some ammo for their toolkit. So they don't want to be perceived as too lenient. And there's been a lot of political pressure, for example, from the Congress to be tough on the big banks. So
that's right. I think Senator Warren sent a note to the Federal Reserve saying, don't extend the SLR because if we have that, then they will have capital to pay out in terms of dividends. It was something like that. I can't remember exactly.
And also, number two, Basel III is binding. Everybody signed on Basel III. Like all the banks in Canada, banks in Japan, banks in Europe, even banks in China, they have to follow Basel III.
Right. So for those who are interested in Basel III is not another rerun of Faulty Towers, but it is actually Barton got it. I was wondering if he was going to get it. But Basel III is actually a set of agreements that the World Banks agree to in terms of the amount of capital that they kind of almost the rules upon which they play. Have I got that right?
Yeah, it's agreed upon in 2010. This is sort of negotiated by IMF and most importantly, the Bank of International Settlement.
Right, the BIS. And I guess the third, that's the third kind of major rule changes. Like there was the original Basel, and then there was Basel II, and now that we have this Basel III that was done post Great Financial Crisis, right?
That's exactly right. And it's funny you mentioned this because to me, this is like an operating system for the bank's treasurer that was written in 2010, but it was put into practice only in 2018. And then, by the way, they actually wrote a Basel IV and agreed upon in 2017, which will be put into effect in 2023. So something else going to blow up in 2 years.
The law of unintended consequences. What is this last chart you brought here? And he says, why now? Walk us through what we're looking at here with this, the total assets, I guess that's of the Federal Reserve, and what point you're trying to make there.
This is the total assets on the balance sheet of all commercial banks in the U.S. that we're looking at for the past 5 years.
Okay.
And you can see that there was an initial huge increase during the first months of COVID crisis in March. And I highlighted April 1st. That was the decision date of from Fed when SLR was exempted temporarily, because it was really getting to a level that market making for the Treasury bond market has been impacted a lot.
Right.
So my working theory right now is for big banks, they have equity derivative desks, they have equity desks, they have rates desks, they have foreign exchange desks, right? Like every desk probably have a certain allocation of amount of balance sheet space from the bank holding company can be used for their trading activity.
Right.
And when we're getting close to the ceiling of a regulatory constraint, when compliance departments will call you, it's going to be some trouble. And it's a very short-term trouble right now. But back in April last year, it was systematic trouble. So at that point, Fed kind of exempt this SRA.
Right. That was the reason that they put the SLR beside, because they were having enough trouble with everything. They said, listen, you guys, you want to buy bonds, knock yourselves out. No, you don't have to put up any capital at all. And now, to some extent, I think you might argue that the Fed has allowed the SLR to come off and to expire. And this is causing hiccups in the stock market and the risk assets. And I would almost argue that the Fed probably doesn't view that as a bad thing.
Yeah, I think there's just too much speculation in the market right now, and it's probably a little bit of cooling off is a good thing, right?
Right. And so maybe from that perspective, they're looking at it as it is accomplishing what they were looking to do. Now, so let's talk about this. You've noticed this pattern. How do you go about using that pattern in your trading?
Yeah, well, first of all, this thing is going to get worse in the next couple of months, right?
Okay.
Because if you look at this chart, the total assets has really started to climb, I would say, after October last year. And now you have TGA still at 1.1 trillion. Need to come off, right? And turn into bank assets.
Let's take a step back and let's explain TGA, what we're talking about. And you were actually the first one, I think, that ever taught me. I might have taught you about QE and the stock market many years ago, but you were the first one to explain to me TGA, and I'm forever grateful for you for that, Barton, because it was a huge wake-up call. Why don't you tell people what the TGA is and what's happening to it over the next little while?
Yeah. Thanks, Kev. TGA is basically the checking account that the U.S. Treasury Department has at the Fed.
It stands for the Treasury General Account. Like like you say, it's a checking account.
Right, and it's very special because we're looking at the big pie of which is Fed balance sheet, and this TGA is going in competition or directly against as bank reserve. Every time money goes into TGA, bank reserve shrinks. That's the available base money that banks are using.
Okay.
And when TGA grows to a large size, it's equivalent of shrinking bank reserve, and it's kind of a QT light. And another very famous analyst, Zoltan Pozar, will call it sterilization of QE.
Okay.
So TGA is kind of an anti-QE if it's growing.
Right.
And last year, the then Secretary Steve Mnuchin decided to let TGA to grow to an unprecedented size.
Yeah, stupid. What was it? 1.5, 1.6
1.6 at the peak.
Yeah. So if you think about it, like the way I like to describe it is they basically borrowed the money and like pre-borrowed it and then didn't put it into the economy.
without doing there was no spending bill, nothing attached to it. It's just pre-borrowed, thinking, maybe we'll
Yeah,
we'll
I
use it.
still don't know what he was thinking. If he just got drunk one night and just said, "Oh, we better borrow it," or maybe they got scared and they looked at it. And the one interesting thing I will say, Barton, is that I thought that this guy's a genius. He's pre-borrowed it and he's going to let it all go out in the month before the election to try to goose the economy and goose the stock market. And he proved that he was no genius. He just let it go. So
I thought that too. I even went on Real Vision to say, hey, Steve is going to dump all of this to the banks before the election.
Barton, you goochered it by getting on TV and making that prediction. That's what happened. Okay, so the TGA now, so he gets it up there. It ends up being 1.6 trillion. And now Treasury Yellen takes over. And for the first time ever, she says, or the first time since the COVID crisis, she says, listen, we're going to spend this down. And I actually didn't understand why she was spending it down, but I guess to some extent she needs to spend it down to do some budget things, right? So there's something about it. I can't remember. So she decides to spend it down. And this is what was happening right now, that there's this flood of money. We're having quantitative easing and TGA getting put down, spent out into the economy. And this is what you're talking about with the amount of bank reserves getting shoved into the system. And you are arguing that this is actually going to cause this indigestion, like your American sicko. Why don't you walk us through how the TGA causes that indigestion?
Right. So if we look at the numbers, Yellen has about $1 trillion of money to get out of TGA to satisfy the debt ceiling constraint.
That's what it is. So she needs to do that for the debt ceiling constraint.
It's a soft ceiling. It's not something she has to do, but they like to do it just to follow the convention.
Okay.
As long as the Congress doesn't give her trouble, she can keep it at this level. So that's one thing. We have so before the COVID crisis, the U.S. has been running about $1 trillion of deficit every year. So now with the new spending bills, we're running about $3 trillion deficit this year. So that's another $3 trillion added to the bank's balance sheet.
Right. And then so walk us through. So they spend this, we're going to spend it over the next 3-6 months. And so why does that cause, perversely, why does that not end up being positive for the stock market and risk assets?
So unfortunately, right now we're just right at this SR constraint,
right,
or very close to it. Zoltan posed our recent notes that's about we're at 6%, so we're like 19 times, which means with all this spending, without the banks writing any loans or issuing new corporate bonds, new money into the corporate bond market, just from the federal government spending plus the refinance and cash out loans for the mortgage-backed security market, that should force banks to raise about $200 to $250 billion of new capital this year. And a typical year, all the banks in the U.S. probably in a good year, they do about $125 billion of buyback. So $200 billion new capital, $250 billion is a lot.
Okay. So in essence, they're shoving this out there into the system, and it's actually requiring the banks to come up with more capital or to make less loans.
And no buybacks.
Right. Which is what good old Elizabeth Warren wanted. Okay. So that's what's happening there. Now, why don't you walk us through you track all this. How do you take all this great sounding theory and turn it into dollars in your bank account?
It's actually quite simple. So basically, I track these liquidity flows from the Fed, the Treasury, and Freddie and Freddie, and I look at whether it's a net positive or negative. And these agencies right now are really bipolar. There are days they really shovel $100 billion, like yesterday, into the banking system. So I would just bet the market will go down by puts before this happens, and then cover my puts when this is done, because this is temporary. The banks have ways to adjust for this. They can literally print money to take out bank reserve and turn it into cash. That's relief for their balance sheet.
So to
they
some
can,
extent, people are sitting around wondering why the stock market is gyrating up and down. And your argument is there's some plumbing going on that is directly affecting this, and there's more can be explained than you can imagine through this plumbing.
The correlation is just too good to be a coincidence.
And so you sit there and you follow it, and because you think that there's an edge in following all this. Now I get it. That's great. Now the other thing I wanted to talk to you about is that not only are you an expert in plumbing and all this kind of fancy quantitative easing and quantitative tightening and all that stuff, you're also a little bit of a option kind of aficionado, or an expert. And one of the things that I saw on your new service is that you were talking about the 38.95 calls on the S&P. And I thought it was really interesting, and it was some great color that you were providing for me this morning in terms of what this order or what this open interest is and what's most likely going to happen to it going forward. Why don't you tell us, first of all, what it is, what the position is, how big it is, and what you think it's going to happen?
Yeah, this is a great question. So I'm glad you asked about it. Basically, there are two things I think matters for the stock market right now. One is the liquidity from the Fed, the Treasury, and all that. And second thing is the option, which I call the tail that wags the stock index stock, right?
Okay.
So what happened yesterday was a very special scenario where we happened to have this large number of short call positions for the month and quarterly expiration. So March 31st.
Okay.
On the 3895 strike.
Yeah, on the S&P. So it's the S&P 500 3895 strike.
Right, where the big boys play.
Right.
Right.
That's right. And that is a big contract because that's 100 times that. It's like 2 S&P futures.
It's like $18 billion of notional value.
Okay, that's what this position is. Some client, a big client out there, a whale, has sold $18 billion of 38.95 calls.
Yeah, well, it's like $220 million of calls. If you just look at a premium, but it's like $18 billion
of underlying.
Underlying, yeah.
Okay,
SPX.
fair enough. Yeah, understood.
And then he sold this quite a while ago, back in December, and now we're close to the expiration.
Yeah,
because next Wednesday, and then there's something about this. Something that's really funny about these options because his counterparties are all the option market makers,
right?
And this client is selling, then we're selling, then those market makers basically have a lot of long calls in their hands. And because of compliance from Dodd-Frank, they have to be mostly delta neutral. So they have also got a lot of their long calls. So they're short E-mini futures to make sure they're delta neutral. But this option is expiring very soon. And its delta is being either decaying to 0 or going up to 100, depending on whether it's in the money or out of money.
Right.
And that variation, the time decay of the delta, is causing the market makers basically buying S&P future when S&P is falling, and selling the S&P future when it's rising. So it's basically 2 steps forward, 1 step back. The market makers always counter.
They're dampening down volatility because they're in effect long gamma, and so when the market rallies, they're selling more, and then as it goes back down, they're buying it back.
Right, so it becomes a black hole of it killed the liquidity, it kills the volatility yesterday.
Right,
and it's kind of pinned SPX near 38.95 for quite a while. What was good 2-3 days ago when it kind of dragged the S&P downwards, attracted S&P downwards in the initial part of the sell-off. But then yesterday was really pinning it down, and it's going to be also some big impact for when it expires on the 31st.
Right. So if they let it expire, then that would continue right until the end of the quarter. But typically, this client has not done that. This client has often gone and rolled it. Why don't you walk us through what you expect not expect, or what you guess might happen?
Yeah. So a very likely scenario will be some rolling happening on the 31st, and at that point, I see probably 90% of chance these calls will be in the money. So it will become a whole bunch of in the call 100 delta SPX calls.
Yep.
It will be rolled into some higher strikes and turn into probably a 40 delta or 45 delta short calls at next quarter or something. So that would mean for the market makers, they will need to be short. So they started with the long 100 delta calls, and they're going into long a 45 delta call in the future. And then they have to trim their hedging. They have to trim their hedges.
And don't forget, their hedges are short, so therefore they be buying.
They're buying tons of
right.
E-mini futures on the day when this is rolled.
So I found that fascinating because I didn't understand that this whale is well known in the S&P option community for doing this at every quarter end. And, you know, whenever we get a situation like this extra 20,000 or whatever futures that he's going to have to buy, or the market makers are technically going to have to buy on the last day, is yet another reason why we sometimes see those kind of crazy quarter end bids, right?
Yeah, exactly. And then this whale is so well known that I think people have been planning for this event maybe a week ago. So this is 2 weeks ahead of the
That's right. So everyone,
quarterly
all the kind of sophisticated option market makers have already gone and done it. And I guess to some extent, you know, he is, if by being consistent, he gets it priced at, you know, the most competitively as he can, because what ends up happening is everyone knows what it ends up like, what he's going to do, and so therefore it kind of almost becomes an auction, like, you know, just like the Federal Reserve when they go sell bonds. The fact that they've gone and told everyone and given everyone a long time to digest about how many, you know, are for sale and stuff like that, it actually becomes a more efficient process. And I was just, because I was trying to think through myself, why is he being so reliable? Why is he doing this? And that was all I could come up with. Right.
Yeah, that's helpful for the market to absorb this, but also trigger people to front run his trades, right?
Yeah, for sure. It'll you know, front run their trade. But when you're dealing in that sort of size, to be able to execute, actually, you need some people to be in position to be able to bid, right? It's not like when you and I go and, you know, sell a 10 lot of S&Ps. You know, this guy has to do serious size. So inevitably, you know, he'd be better off just telling people what he's going to do so that he can execute the trade, because otherwise the quote's not going to be at a level where he's actually going to be able to transact.
Yeah. This is a really nice whale, as opposed to some other whale.
It's a nice blue whale as opposed to an orca. I don't know if an orca is a whale, but anyways, it's probably not. But I hear what you're saying. I think that this whale realizes that over the long run, that if he's going to transact and do this strategy, and I guess he's been doing this strategy for a long time, rolling them every quarter, that he's better off working with his counterparties as opposed to completely against them, because you can pick, you know, one of these dealers off once, but the next time you go to do your trade, you'll all of a sudden find your bids are really bad. So I think that, you know, a lot of people in the institutional community don't realize that yes, there are hedge funds and other clients who pick off brokers, but then the next time it doesn't end up being as good. In the same way that the brokers can pick off the clients, but at the same time as they do that, then they don't get any orders. So it is kind of a symbiotic relationship at times.
Right, exactly.
Yeah. Okay, so listen, Barton, this is some great stuff. I'm really enjoying your new service. Why don't you tell people where it is, where they could find it, how it works, the whole 9 yards. Here's your time to give us the spiel.
Yeah, so I'm actually pretty excited to announce here. This is the first podcast I ever gone to talk about my newsletter. I started a newsletter last Friday, and you can find it at this URL, very short, fed.tips, Fed.Tips, that people can sign up and read my daily and sometimes weekly sort of musing of the Fed actions, Treasury actions, and how the market may gyrate around them.
Yeah, it's some terrific stuff. It goes through all the things, so we get to see all of your kind of calculations. You share with us the inner workings of the Barton spreadsheet that must be, a gajillion, as big as anything, and it's terrific stuff. And so once again, it's Fed.Tips. And that's the URL, and you can sign up there. And if they want to follow you on Twitter, Barton, where can they find you?
Yeah, my Twitter handle is Barton, BARTON _ options. It's plural form, options, on Twitter. There are lots of fake accounts these days, so make sure. Yeah.
Got to get the right guy. So, Barton, listen, I wish you all the luck, and I really appreciate you coming on the show, telling us what you're thinking out there. As I said, I've been a big fan of your work for the longest time in terms of figuring all these things out. I feel like that you have a handle on the plumbing better than almost anyone. Maybe Zoltan, has got it just as good as you. And by the way, actually, I shouldn't let you go without telling people what your tagline is. What is your tagline?
Yeah. One of my goals of having this newsletter is basically to translate Zoltan's his relatively high finance views of how Fed is doing things into understandable English where traders can act on.
So for those who don't know, Zoltan is one of the most, in terms of short-term traders, the people that trade short-term fixed income instruments. He's like the god, the guru of these things, and everyone bows down to him. And yet it is difficult at times to listen, to figure out what he's saying and things like that. So for those who are interested, Barton is going to give you the English version of Zoltan's musings.
And also how it affects the equity market.
Oh, that's right. And the equity markets. And some great option stuff every now and then thrown in for good measures. Anyways, Barton, it's been a pleasure having you on. Thank you very much, and all the best on your new endeavor.
It's awesome to talk to you again, Kev.
All right, Patrick. Time for that black magic. Talking charts. What do you have for us this week?
Okay, well, let's just start with the top three things we were watching last week. And just quickly review. We were talking those Fed speakers. We were talking post-OPEX volatility and oil. So let's hit on all three. Anything that caught your attention with Fed speakers?
No, the Fed speakers, they just continued down the same path. There was no change. They just continued to be dovish, but it doesn't seem to matter.
Right. Well, when we got to post-OPEX volatility, there definitely was some, but it wasn't really in that main S&P index. A lot of individual names, particularly driven by, I guess, a lot of the gamma swings that came off of that, and certainly volatility in some of the sub-markets. But anything that caught your attention in the post-OPEX?
It's actually, I'm surprised that this wasn't a more volatile week, and it's getting a little bit boring. And we will talk about some of the things that are happening, so maybe we'll just leave that. And we'll save
that for a little bit.
Yeah.
And the other one we were talking about, oil, and oil the prior week had that one nasty drop here. I'll just show it, and then really it's been chopping. I mean, we did get down to $57 on the down side of the market, and so we've been whipping in a $5 range, but on Patrick, a day in day out basis.
This is the oil market is definitely in a strange spot because a cargo ship captain pulled in the Suez Canal. He pulled an Austin Powers.
Yeah.
And he decided he's going to try to turn around and he couldn't do it. And so his ship is stuck there, and it's a disaster. And then, so we're getting a lot more volatility in the oil market because of that. Having said that, I thought that, we had the initial extra down. It was looking really bad. Then we had the Suez Canal ship kind of rally. Then some weakness again. And then today, to me, felt like it actually was feeling a little bit better. Like it feels like it's almost maybe behind us. It'll be interesting to see if that's it for oil and we actually can head back higher from here.
Well, you know what? This is a first frontline support along this 50-day moving average where oil is. There's the one thing I just think that a lot of market corrections tend to last longer, and so even multiple weeks of correcting. Even though I'm not bearish oil, I'm concerned that it would be a little too early to already be thinking it's going to be straight up from here. But we'll see. One of the things
that ship captain's got like a lot of there's probably 200-300 turns he's got to do before he can turn it around. So
There you go. Okay, let's talk about the top 3 things for all of our listeners to watch for next week. And obviously, we're going to have the job numbers coming out at the end of the week. Is there something you're watching for there?
It's always a big one. I still think the inflation means more than the jobs, but there's no doubt about it. The market's expecting an uptick. I guess so you watch the hourly wages in terms of in the actual job numbers. Maybe that ends up being something that the market starts to focus on more.
Right. So number 2, I wanted to just touch on the volatility index and the VIX. I mean, we had a pretty solid bet on this before, but I'm actually a little bit surprised because we rolled off into the OPEX and we basically had some volatility. It wasn't crazy volatility, but I look back to what happened in January and in late February and early March. We had these big spikes in volatility that just came in on the first turn. Like immediately volatility premiums got jumped up and as people were buying protective puts and other things. And the VIX didn't even move this week. I mean, we stayed down right along that bottom of the range. And
below
it just seems
20, I might say.
Yeah, it's almost like we should have made the bet a second time, right?
Well, or we should have made the bet close on any time except for Friday afternoon. Well done, Ceresna. Well done. You got me. Literally, it closed one day above 20, and that was the one day.
But, I find this fascinating because I continue to think that, like, this is not a time where there's a room for markets to be extraordinary volatility and volatility upside as well as the downside. I'm not talking about just an ominous downside move, but you would think that volatility premium should stay in the markets for the potential move. It's the idea that this is just going to get cheaper here.
I don't know. 20 is not like you make it sound like cheaper. 20 is like 10. Like,
we are selling at the lowest vol premiums
since COVID. But
since COVID.
Okay, take out COVID and then look at it.
Yeah,
then.
but there was that huge vol selling regime that existed. You think that's coming back?
No, but I just think that it's not like I remember 20s used to be a great sale in my day.
Yeah,
and I also remember walking to school and the snow was up to my chest. Right?
Come on, but if you keep dropping vol, then you're just
I just don't think
all these people that have been conditioned to weaponize gamma are going to just have a field day.
I disagree. First of all, this is not vol on individual stocks you can move around. This is vol on the whole index.
But
and then the next thing is, I really don't think that 20 is that cheap. Or 19 or wherever we are.
Well, it's the cheapest it's been in a year.
Yeah, I just think you guys, the kind of perma bears that you love buying vol because it's had some great trades for you. But when you go pull up a long-term VXX chart.
VXX?
Yeah, like the actual, because don't forget when you're trading.
Yeah, you got to roll.
You got to roll.
It's been a bleed. Yeah, for sure.
But let's go from 2000 or whenever they made this thing. There you go. Wealth destruction. It's like you guys listen. There's no doubt about it.
It's been a zero. There's no doubt about it.
It has its place. There are times that it makes sense, but on the whole, the trade doesn't work. And I guess the other thing is the S&P. It's up $61 today. To me,
if you're now shifting it. So I think we're having two different conversations here because you're really talking about the idea of being long the VIX and the idea of the VIX as a trade. But to me, I'm talking about the idea of volatility premium in options as an aggregate. And I use the VIX as a proxy of how much volatility premium one has to pay up to be long gamma. Right. And to me, I just think that the markets are poised to do extraordinary. Whether it's you look at Brent's work where just people are not insuring the downside or versus the idea that we could have extraordinary upside moves. I don't think volatility should be that cheap. I think you have to, the fact that they're giving it away at 1 year lows in a period where the market could potentially make big moves, I think it's a gift.
So Shock, the guy that loves buying options, is upset that volatility is going down, and he thinks it's
I'm not.
Anyway, that's fine. That's what makes a market.
All right, so here we go. Number one, shot across the bow. We what crazy price action we saw in the last few days on a number of these names. Like, what was it? Some fund got liquidated here.
So I'd like to talk about this because this morning at about 8:30, I started to hear rumors that Goldman Sachs was shopping about $3 billion of blocks in Chinese internet names. And at first I thought it was just related to the ongoing escalations of tension. So the three that you originally heard that we got on the desk was VIPS and Baidu and TME. So first of all, the kind of crazy thing is, when the hell, I wasn't paying attention to these names, and the decline even going into this morning was huge. Let's just take this Tencent.
I'm sorry, but you're talking Friday's price action, but these drops started Wednesday.
Exactly. That's what I'm saying. I'm shocked that these were down as much as they were. So something was happening. There was somebody selling, and there was no bid. So we got these chatter about these names for sale. Big
These
blocks.
are like 50% wipeouts in stock value.
So 10 million Baidu, 50 million TME, 30 odd million VIPS. Okay, so that's going along. Everything's, it looks like it's, confined to the Chinese internet names at this point, right? Then all of a sudden you start hearing more stocks for sale. You hear Discovery. FTCH. What is FTCH? I don't even know what it is.
What drove Discovery up this high in the first place?
Well, yeah. So we'll get to that. We'll get to that. Okay, but so FTCH, 26 million for sale, and then almost $750,000 Shopify, good Canadian name. Yeah. So we have these things, and it's just like a bloodbath. And what's amazing is that these stocks are getting pummeled. Let's just pull up. Let's start with. Let's do Viacom. That's the one that seemed to be the worst.
Unbelievable.
And pull up the action of today, the daily action, Patrick.
Well, I mean, it went from 65 to 40. So I mean, here, let me put. What do you want? 1 hour, 5 minute? What do you want?
Sure, that's good. But just look at this thing.
This is the 5 minute chart basically. This thing gaps from. Unbelievable.
And this thing's already down size. Okay, so now the what it is. So we later learn. I originally thought it was SoftBank because there was an article out there that SoftBank had gotten in trouble with their SEC, and there was, if you go look on the Bloomberg, there was kind of an article this morning about SoftBank getting in trouble with the SEC. Let me just read it out here. SoftBank is reportedly under investigation by the SEC following its risky NASDAQ whale investments. Okay, so they supposedly are in trouble, and this coincided also with the sell order starting to hit. So at first you think it's SoftBank, and everyone thinks it's that. We've subsequently, rumor mill says that it's this fund, Archegos. I don't know how to say it. ARCHEGOS. Okay. And me asking Patrick for pronunciation advice is just kind of
don't do it.
I'm sure someone will be able to come up with something very funny. But anyways, so this is a fund managed by some tiger cubs, or maybe one tiger cub. And Tiger is obviously an offspring of Julian Robertson, the very famous late 90s hedge fund manager. And his name is Bill Wang. I don't know how to say that. Anyways, he got taken out by his by his prime broker. This is just shocking what happened in this market. And what I find fascinating, Patrick, is that this was some real chaos happening in these names. Just it felt like in those names, it felt crash-like. And obviously it was. And what's interesting is that the S&P was, screaming higher. It almost feels to me like he was short Spoos or on the other side. Because that's what it feels like. It really does.
Like a full-on squeeze.
They took him out of both. And if you watch carefully, you could see when the waves of selling came in the names, it would often coincide with an uptick in the stocks. So to me, the question is, was today this hedge fund liquidation and the S&P almost artificially sent higher in thin markets? Or was this legit, or is it quarter end markup? Who knows? Lots of things happening, but there is no doubt that this is a dangerous shot across the bow. And if we do have something more serious develop from here, we'll be able to point to this and say, look, this is where it started. And I'm not trying to say this is just like the Bear Stearns event, but remember, Bear Stearns, the first thing that happened before they went and got into trouble was their hedge fund blew up.
Right. Okay. So what really bugged me before this entire thing even started was what business does like this entertainment company? I mean, like Viacom, what TV entertainment, cable networks, advertising, all this shit like that, broadcasting. What the hell from November, right? This stock goes screaming higher like they're buying Bitcoin. 260%, 270%. Like in my mind, it had no business doing this in the first place.
Right.
And so this was just one monster mean reversion, correcting
But
something
Patrick,
that
isn't that symbolic of a lot of stocks?
Well, it is, right? But the thing is that let's kind of size up though what's drove the S&P. So this is where I want to continue this conversation. So anyway, let's
Wait,
continue
before we do it, you get on to your voodoo magic stuff. I just want to say that when you have markets that are up on air like this, and then someone demands liquidity on the other side, what we're finding out is where the real bids are. Right? So it's one thing when you have 1 million shares of Viacom to sell. It's another when you have 100 million or whatever they sold. There's a 32 million share block, but there's no way it was only 32 million. So the reality is that when you have size to go, what we basically experienced on these names was where the real bid is. And that is symbolic of, I think, the entire market. Anyways, that's my 2 cents.
All right. No, you know what? I agree. And so I wanted to, though, talk about some let's look under the hood and try to see what's going on here. And so like the S&P had this big update, right? And almost any technician out there is going to see this as a bull flagging formation that did a 50% retracement and is poised to make a fresh new 52-week high as it's going to go screaming 4,000 plus on the upside. I mean, that's a technical pattern that is as evident as for any technician to see that that's what's setting up. But the thing is that what's driving this? Because we saw that Tesla's down today. Let's look at ARK, right? So Kathy didn't react on the upside today. ARK investment is still down at 114, right along those lows, right? And you take Tesla down on the day, right? It's down at 620. This is not what's driving the S&P. Even arguably the FANG, while it's up 35 points, it's still right at the March lows when you're looking at the FANG futures, right? And so this is not what got bid. So this is where I want to kind of dig a little deeper in what the hell was rallying that drove this S&P 500 move. And when I go here, I'm going to look at just a basket of ETFs. I'm going to just highlight this one. This is the XLP, Consumer Staples.
Wow, I didn't realize it screamed like that.
Look at the way the Consumer Staples from $63 to $68, but it's about the fact that it wiped to the upside the entire distribution cycle of the year in one fluid motion, right? And so, like, what makes up the XLP? Procter and Gamble, for instance, is one of the largest holdings, right? Screaming off of that low. Coca-Cola punching higher. PepsiCo getting some real tailwind behind it. Move to like Costco way off of its lows on the downside. Colgate-Palmolive ripping higher off those bottoms. Even look at the way the tobaccos have been running. Like, look at this is Altria Group, just the way they've been screaming. And suddenly, everyone's been ignoring these consumer staples, and they're running.
Yep.
They are in. Now, what is that? What is that in? I would basically sum up the trade with this chart right here. This is the ETF of the iShares MSCI minimum volatility factor ETF, which is basically the low vol, low beta names. Look at this break to fresh new highs. That money is flowing. So this is rotation. Everyone's getting the hell out of the high beta tech names, and they're rotating into the defensive low volatility names. This thing is running. This is the big theme that's underpinning this entire move.
So do you view that as bad? Like in terms of not bad. Do you
Well,
view that
no, but
as
that's
like
no.
scary
I
for the markets?
do. No, I view. It's the stealth bear market, and you're the one who's always talked about this, so I'm not going to try a thing like you've talked about it. You don't have to have a liquidity event where the stock market is crashing broadly. Like a liquidity event is all the correlation of all assets goes to one. It's to the downside, and they're all getting slammed in one big margin call, right? But what we're seeing is all of those bubbles that ran for the last that were the big things that worked over the last year. They're all being sold, and any of these asset managers that are trying to bank these profits that can't go to cash, they're rotating low beta. They're just basically it's the one monster rotation that's happening. Like look at this. Like this is the let's take a look at REITs. This is the XLRE fresh highs. REITs.
Yeah.
Right, like they're running like even like I'm not saying it's impressive what's happening with the utilities, but utilities are rolling off of their lows. Your home builder babies are running like and even like materials. This is the XME still turning back up.
It's like the reopen trade is going.
Yeah,
like it's going to real economy.
Or here's a fresh high on the materials index, the XLB. Right? Like, so what's happening is that you're not seeing any of the techs moving, and suddenly everyone's back and playing these consumer staple names, all these boring things that were left for dead, and they're all that money's rotating there. And I think that the bigger question here is this trend continue? And certainly that doesn't bode well for all of these things. Like I know that. One thing that Jay was talking about was Peloton and Zoom, right? And when you look at, let's say, Peloton, the thing can't get off the mat after a couple months of selling. Zoom, you take a look at this thing. This thing has been selling since October and is right along its 4 or 5 month lows. This is not where that money is flowing. You're right. It's about the reopening trade, the materials, and all of these other plays. They're the ones taking the money. So low vol consumer staples. It's what's been working in the last 2-3 weeks. It's pretty amazing the way that this has really gained some traction.
What's even more amazing is how you've dissected that for us, Patrick.
Oh, stop it. All right. Anyway.
Well done.
So
I just give you a hard time. It really was well done. I didn't realize that they had actually run this. Today was
another sector. I forgot to mention it. Transports.
Yeah.
I guess the Suez Canal plugging up suddenly the transports are back in business, right? But even the transports are running. So anyway, it's a really interesting way that this market has shaped up, and I'm really going to be curious to watch and then with my members over the next week or two whether that trend continues. Anyway, that's all I got, Kev.
Well, it's great. And we all thank you, Patrick.
So stop it.
What do you got for this week in trading history?
All right. Well, okay. So let's, for this week in trading history, I want to go back to March 23rd of 1792 for the panic of 1792 and talk a little bit about William Dewar. Now, we've talked about 1792 in the past. That was when they formed the first central bank of the United States and other things like that. But I want to kind of take a different storyline within here. So William Dewar was the first assistant secretary of the United States Treasury and was arguably Wall Street's first inside trader and was thrown into debtor's prison where he would spend the rest of his life. So imagine that, a U.S. Treasury Secretary going to like that would never happen today, would it? Anyway.
Well, no, because most of the stuff that they do that is a little on the iffy is actually allowed, like insider trading from the...
That everyone just turns a blind eye.
Well, it's not just to turn a blind eye. I think you're allowed. I think it's considered a perk of the job.
So anyway, he was thrown into debtor's prison after his speculation in the Bank of the United States shares, and which was that central bank, and the uncovering of him owing the government more than $250,000, which actually in 1792 was a lot of money. Right, and so resulting in the loss of confidence, leading to a bank runs and panic. So Dewar was ruined by that panic of 1792, in which played a prominent role in speculating on bank scripts. And what's cool about bank scripts is that we don't really know about them that much today, but they were the equivalent of like warrants or options back then. And so news of Dewar's failure spread fear around the city, forcing many investors and institutions to needing to prove their solvency. And over a 2-week period, stock markets would decline 25%. But 25 banks would fail on this one day alone on March 23rd in 1792. The panic would be slowed by Alexander Hamilton using the U.S. Treasury to prop up stock and bond prices until the markets calmed in April. So let's just kind of dig a little bit deeper here and put context on the story. So the War of Independence was concluded and left the country with significant debt burden and needed to establish a sound financial system. And of course, Alexander Hamilton, the first U.S. Treasury Secretary, was at the time driving what became known as the financial revolution of the United States, and set reforms and developed many of the institutions which became foundations of the U.S. economy. So what happened in this 1792? The panic was actually a period that followed a dramatic turbulence in security prices in late 1791. And the volume of trading in the securities skyrocketed in that period as government bonds were sold quickly and cheaply to finance national debt. And the government set up that first central bank of the United States, which we covered it prior in these weekly sessions that we do. So let's talk a little bit more about this William Dewar, which was actually a personal friend of Alexander Hamilton. And so now Dewar and his speculative banker colleagues aimed to acquire the Bank of New York through an elaborate plan to first inflate and then rapidly deflate prices of the bank stock through a kind of double dip by assuring each other's own notes. And the goal was to corner the market for the securities known as the 6S's. These were 6% deferred bonds, which formed a part of the payment shares in this new central bank. So the problem was essentially that Dewar and his colleagues borrowed a substantial sum to fund their little master plan, which ultimately led to them defaulting on these loans and causing the panic and the run on the banks. It was rumored that he owned as much as $3 million. Again, we got to think back to that. That was a lot of money back then, which and soon was to be declared insolvent. Particularly, so this created a lot of crisis back then. So luckily, preceding this crisis, so move back earlier in the prior year in 1791, had seen Hamilton establish a fund called the Sinking Fund. Think of it as the first plunge protection team fund, which Alexander Hamilton was able to persuade the executives within the government to once again use to rescue the Bank of New York. And of course, the primary casualty of this was William Dewar's maneuvering. And so it actually was like the plunge protection team coming in with the sinking fund that basically foiled the plan and caused this actual panic, as it caused him to go under. In the end, the government was able to buy up the surplus stock and therefore stabilizing the market. But the government doesn't ever do that anymore, right, Kevin?
No, never.
No, that's unheard of. Nonetheless, with the Bank of the United States was at the time still very new, and Hamilton had to rely on the more established Bank of New York to stem that panic. But the banks at the time were encouraged by Hamilton to continue to extend credit with the debt securities as collateral. But in the end, by April 16th, the whole thing had come back to normal. And really, it was a really interesting story. You know, a lot of what happened there were the foundations of establishing the U.S. financial system, the first real financial crisis that they had to deal with a central bank that had to and using monetary tools to stabilize the markets. And back then they had a debtor's prison. We should maybe consider bringing one of those back. What do you think?
Just for the hedge fund managers, buddy. Just for the hedge fund managers.
Anyway, that's all I got, buddy.
Okay, thanks for that, Patrick. Now it's time for Skin in the Game. And I think I got one, eh?
You got one, but I was hoping you were going to It was the dollar trade. We were basically an over under 92, and you know what? I was bullish the dollar. You were bullish the dollar. I chose the wrong level. You took it, and I donated a pitcher of beer to our listeners.
That's right, for the piss up.
For the Market Huddle piss up. So I that's a worthy cause.
I think it's kind of BS though. You should be trying to win everyone. And
I should listen. You took the side of the trade I wanted, which means I mispriced it. It's not.
Okay.
I should have been a little more aggressive to kind of make you want to take the under, and I think I did it too close to the mark, and you just basically took it. Anyway,
okay.
It is what it is.
So let me tell everyone about this.
Rules, yeah.
Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows. Everyone knows it's beer and the carcasses of animals. The winner of the bet
at different tiers.
Yeah, that's right. The winner of the bet is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of the positions because we're all looking forward to the Market Huddle piss up when we're finally allowed out. So it's my turn to bet.
Yeah.
So I'm going to do a fun one. We were talking Viacom. I figured that we should do that one again.
Okay.
So
VIAC is fine.
Yep. So we'll pull up a chart. Okay, this is what I'm giving you. So the low today was 39.81. And I'm giving you 39.80 one touch.
That is going back down there?
Yep.
I'll take the over.
Oh, damn. Okay. Well, I guess you got me. Shit.
Well, how do you wait? You still have a chance.
I know I have a chance.
All right, I want a burger out of this.
Just like the Dumb and Dumber guy had a chance when he with the although he did get her at the end. He did get her, so maybe there is a chance. You want a burger out of this? Well, do you want to do a picture just for we continue this? We do have a lot of Market Huddle piss ups.
Yeah. All right, let's do the picture.
Okay, a picture it is. Okay, Lena, there you go. 39.80 one touch Viacom. It has to be in regular market hours, by the way. Some people have asked the other day.
No, regular. It has regular trading hours.
You're not allowed to ticket there, Patrick, when nobody's. Although I should have done that and ticked it there while no one was watching. Okay,
there you go.
Although it'll be an expensive, tick.
Yeah. All right. Let's move on to the No Stupid Questions, and this is where we get to let Lena take over, so we don't have to do as much talking.
Third.
Yeah. Lena, hop on.
So the first question this week. Great show. I drink along with you while watching or listening, except when driving. What is the best way to buy foreign government bonds in their local currencies? My interactive broker only has international bonds in U.S. dollars. Please don't give me a stupid answer.
So the problem with
we can't guarantee that.
We probably should just stop there. Because of course it's going to be stupid. One of the things that I would suggest to, I think this is Seth, by the way, because I think I took his side effects at the beginning. Anyways, the one thing I might suggest to Seth is to say, go look at the ETFs lots of ETFs, and even though they're priced in US dollars, you have to remember if the underlying assets are priced in another currency, then you will get that foreign exchange exposure.
So the perfect example of that is the EMLC, and this is just one of a number of choices. But the EMLC is the VanEck Vectors. It's the JP Morgan Emerging Markets Local Currency Bond ETF.
Do you know what's funny, Patrick? We did not plan this or talk about this at all, and you were ready with this.
Well, I just know it. I track it. So, but this is an example of an ETF where you could buy local currency bonds, and it's a way that you can play that.
Right. So that's what I would suggest. Now, if you want to, you can always go try to find the other currency bonds. And I'm not sure that Interactive Brokers doesn't allow you. Maybe I'm wrong. Maybe they only allow US dollars, but if you were really wanting to do it, you go and you get yourself a bond account somewhere and trade it directly with those desks. The reality is that usually foreign currency bonds don't trade that well. That's the other problem, right? Like you
have liquidity issues.
Yeah, and
transparency, getting reasonable.
Anyway, so
quotes.
I just think what I would suggest is go look at the ETFs, because I think the ETFs are probably going to be much better, and that's what you want.
And sometimes you even have options chains where you can put on some hedges and other things like that.
Okay.
Anyway, so let's go on to the next question.
So that last question was actually from a listener named Joe. This is
Joe. I'm sorry, Joe. I'm sorry. That's now this is Seth.
That's what happens when after a couple of beers.
That's right.
Yeah.
Okay, so this is Seth's question. So regarding last podcast discussion of building new airports, Kansas City is building a new airport. We love visitors, so I guess
he works for Kansas City Tourism.
So here's his question. If theta decay is not linear and equity options are widely American, why would people hold options to expiration, assuming a liquid market for said options, instead of buying a longer dated option with the intent of selling it before expiry to try to minimize theta decay and possibly find lower implied volatility? Example, why buy a 3-month option to hold until expiry when I could buy a 6-month option and sell it in 3 months?
So the answer is, Seth, you're absolutely correct. Like, I don't know why people don't do this more. And obviously, listen. There are times that you want to bet on the final moments of a stock, and you will want to do it, and you will want to take delivery of the stock for whatever reason. But on the whole, for using options, I do believe that too often people view it as a trade which they're going to hold to expiry, instead of thinking about it as a trade that they could hold for a month or two and then roll forward. And will notice that some of the more sophisticated, institutional types do that.
All right, so let me push back on you here.
Okay.
So not push back, but just some of the other considerations, right? Usually when you go longer duration options, immediately you're fighting less liquidity in the options chain, wider spreads. So you're going to immediately have to deal with the less liquidity in that. Doesn't mean you can't get a good fill, but I mean it's certainly a consideration. And but the second factor is the convexity of shorter options, which is you're getting the gamma, which you in many cases, okay, look, if I'm taking a fundamental view that I think something is going to happen over the course of a year, then matching it with a 1-month option is a mismatching of the time horizon with the option. But a lot of times, a lot of the reason people use shorter dated options is because of a specific reason they believe that there's a potential move underway right now, and you want the gamma of the fact that you're gonna, if it starts working in your favor, it starts ripping right away, and the delta's immediately approaching 1, and you start getting that immediate payoff with a much smaller capital outlay. So I'm not saying one is right or wrong, but it's not just a factor of the fact that time decay is not linear. Right? There's other considerations.
There are other considerations, and
this is what makes a market, which is that people can go into the options market and stylize. They can come up with their theme in terms of how they want to put on their trade and what they expect to happen, and then you go and match the right option strategy for what your outlook is and time horizon is. And of course, if you're a bigger macro trader playing a longer theme, then what you said does make sense, but it's not always the case.
No, agreed. And Patrick, you said it much more eloquently than I did. So I'm just going to let it be. It's almost like you do that for a living.
Almost.
Patrick, Lena, why don't you hop on and tell people where they can find more?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right.
All right.
So thanks for tuning into the Market Huddle. We appreciate you all spending time with us. Please give us a follow on Twitter at the Market Huddle. We're there every day. Give Lena a shout out. You know why. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. I should probably put something in here that if you want this, the chart decks, which previous week, we had a great chart deck. Make sure you sign up for the email, and you can get the email. Lena, hop on. I can't remember where they can get it.
It's just on our website.
You just have to go to markethuddle.com.
There you go. Exactly.
That was a hard one, Kev.
I didn't realize. Now, I was going to tell you how you should review us, and I decided that instead of that, I'm just going to read another review. I kind of like these, okay? So this is from North York Jays, and he has nice things to say. He says, fun listen, makes me feel like I trade with these guys all week. Only issue is Kevin has terrible taste in beer. Obviously, North York Jays has never tried a Labatt's 50. I hope you are willing to come to the Huddle meetup, the Piss Up, and we can have a Labatt's 50 together. My suspicion is he's probably a millennial, and all he drinks is IPAs.
It's entirely possible.
Yeah. But anyways, thanks for the great review. I do appreciate it. And that's it. I completely understand. I do have terrible taste in beers, but that's what makes a market.
There you go.
So, Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and you can find me at bigpicturetrading.com. Kev, where can they find you?
I'm on Twitter at Kevin Muir, or you can go check out my newsletter at themacrotourist.com. And listen, which what? Sorry,
is something worth everyone subscribing to.
Oh, thank you.
It's a great letter.
Yeah,
it's
just for the pictures though. 95% of the people are just subscribing for the pictures, and they don't read the articles.
Hey, listen, if you can make a few bucks off the pictures, it's all you need.
Enough, you're right. That's how I'm cobbling together a living, making memes. Okay, listen, you can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
Oh, finally.
Okay.
That's
so funny, Lena.
Lena's the one that's saying finally. It's like finally. She's the one that has to edit all this shit.
Poor Lena.
Right.
We tried to do it one take. Well, there's very little. There was nothing. There's very little edits there.
Yeah, this one was actually one of the good ones.
Yeah.
Yes. But we got to rate the beer.
Oh, yeah. Let's do the beer. Okay.
Yeah.
Who wants to go first?
Oh, God. Well, I'm going to get it over with. I didn't like this one either. It's not.
You picked it.
I know I picked it. It's not good. It's I actually have decided I don't think I like IPAs. That's my problem. And I know that's not cool. I'm just not cool. Let's face it.
You're not cool.
Yeah,
that's the problem.
I'm not cool. I don't like IPAs. I basically just like pale ales or 50s or whatever, things that taste like 50. Patrick has called me out.
You're a Pilsner guy.
Yeah, he's called me out correctly, and so I'm going to own it.
There's nothing wrong with Pilsners.
So I'm gonna. It's not that bad. It's not like I'm not giving it like before, but I'm just gonna give it a 6.9.
Okay. All right. So for me, I do like IPAs, and actually, in my mind, one thing I was thinking is that I can think of at least 5 or 10 IPAs that I really enjoy, and kind of rated this one in there. I'm going to give it a 7. There are better IPAs out there. It's on the more bitter side. How about you, Lena?
I think this was drinkable but not memorable, if that describes it. I would still drink it, but it's
obviously they're never going to sponsor our show again.
Yeah,
with this the screaming endorsement. They're all going to be like, we should send these guys a whole case next time.
But I would give it a 7.2, just an average.
Lena
that is the tightest distribution we've ever had.
Yeah, that's a cluster.
I was going to give it a 7.
If we were at a gun range, people would be impressed with us clustering this shot. Anyway, but that's rare.
Yes.
That's rare, and this is IPA too.
We're
so
on
it's
the same page for this one.
Yeah.
Okay.
I did finish it though. So
Yeah.
It's not bad.
I've got like an inch left on it. That's all right. It was good. Anyway, it was.
So Lena, I have to ask. Yeah. So are you down to one dog? Are we allowed to talk about it?
Yeah. I'm just down to our original toy poodle. So.
You gave them all away.
Yes.
Oh.
We decided that to get married and to have kids and, to have a puppy and all of that happening at the same time is probably not a good idea.
Oh.
So we ended up.
I hope that my telling you that 2 was the worst mistake I ever did didn't affect you too much.
No.
And it wasn't kids I was talking about.
No, we realized how much of an undertaking it was to have another puppy on top of having a dog that needs our attention.
Yeah. Don't lie. Somebody bid you $2,500 cash and you are like sold.
No. But she did go to a really good home. We're really happy with where she went, and we're happy with how they ended up. So all around, it was good. It was a little bit bittersweet because I didn't really want to part with them, but realistically, it was just it was not going to work, right? So it was the right decision for all parties.
Okay, well there you go. So now we won't. I didn't realize that. Otherwise, I probably wouldn't have asked.
So now I just binge watch on documentaries.
That's right. You're like the murder documentaries. Speaking of which, do you have anything new? Because I got a few new ones.
Oh, I have 2 that I watched in the last couple of weeks, actually.
Okay, what do you got?
Operation Varsity Blues.
Okay.
College admission scandal. It's on Netflix.
Okay.
It's about that guy Rick Singer. The celebrities who got caught for bribing.
Aunt Becky, you mean?
Kids into. I'm sorry.
Aunt Becky.
Yeah.
Aunt Becky,
and,
yeah.
What's her name? Felicity Huffman.
Yeah.
William H. Macy's wife.
Yeah.
Or that couple. So it's about that scandal, and I thought it was very interesting about how this all panned out. They actually disclosed everybody that was charged for that.
Okay.
So that was interesting.
There were some hedge fund managers in there too, I believe.
Oh, I'm sure.
Yeah, I'm sure. Lena says, of course there were. There's something illegal going on. Of course there was hedge fund managers.
There's at least one. And then the second one I watched is in 2 parts. Tiger. It's about Tiger Woods on HBO.
Oh, okay.
That was a really good one. That was a really, really good one.
Timing of it is pretty good considering that accident he was in may have wrapped up his story a little bit.
Yeah, so they cover everything from his childhood all the way up to basically the accident, and it's fascinating to watch. I mean, my dad is a big golf fan, so I watched golf many times before, but I just never knew how good he was, and this was a great documentary.
Your dad's that good?
My dad? No, he's a good fan. He's a big fan.
just
No,
kidding.
I don't know if he's good.
I'm just kidding. You just said it in a way that made it sound like your dad was that good. I didn't know how good my dad was.
No, she didn't.
He's
You
good in
just
my
decided
eyes.
to take it there.
So
You just did that, Kev. That was all
What
yours.
were your picks?
Oh, we watched The Stand, which is the Stephen King movie on, I
Yes.
think it's on Amazon.
That's on my watch list right
Yeah, it's, I like it. I didn't read the book. And I'm not the hugest Stephen King fan. Having said that, one of the best books that I read over the last few years is 1963 by Stephen King. I think it's an absolutely outstanding book. And if anyone's looking for something this summer to read, let me just make sure I got this title wrong, right. And let me just look here. No, it's called 11/22/63. And it's by Stephen King, and it's probably one of the best books that I've read in ages. It gets 93 Google user tomato equivalent. Anyways, it's good. I really liked it. But The Stand, it's interesting because I didn't realize it's about a pandemic.
Oh.
But it's got a little bit
Spoiler
of spookiness kicked in there and stuff. So it's I don't know. It's pretty good. I wouldn't say I love it, but I wouldn't say I hate it. It's a quality. It's quality. You're looking for something to watch. It's up there. It's good. I still haven't got around to Archer for Patrick, and I know he's just been watching his 11 seasons or whatever. Where are you now, Patrick?
Oh, I'm not binge watching that much. I'm still wrapping up season 2. But
you got it.
Well, no, but the thing
Long
is
ways
that
to go.
but stop for a second because I did get introduced to it at different parts of season 6 and 7 and stuff. So I sort of know where the whole thing is going. But I decided to start it from the beginning. And
Speaking
so that
of Archer, Jessica Walters died.
Oh, is that the?
She's the mother on Archer. She's
Oh,
the
but
voice
more
for her.
importantly than that, she's Mrs. Lucille Bluth.
That's right.
The
Lucille won.
greatest, one of the greatest. I don't know. No, it probably is the greatest comedy ever made. Don't you think?
Yeah, I agree.
What
was
would
great. It was
what would be
awesome.
better? I don't think there is anything better. Like Arrested Development?
Hard to beat. It's hard to beat.
Yeah. Well, at the very least, it's right up there.
Maybe The Office. Maybe, depending on
no.
how you want to put it.
I think that The Office...
Arrested Development was the most underrated,
for sure.
hilarious TV
It's
show.
so good. And the jokes... I love how the jokes... There's no laugh track, and they just keep the jokes going fast. And there's just like... And the running gags are hilarious. Like my favorite
Patrick, you know
part
what
of
we're talking
Arrested
about?
Development was... Remember when they were... So they were a Fox show, right? That kept getting threatened to get canceled.
Yeah.
And they were trying to sell themselves to Showtime and HBO, like in the middle of the season, as they were doing it. And there was this whole running gag about like the home builders organization, and then there was something else called Showtime, and they were completely making jokes about HBO or Showtime not wanting them. I loved it. Like there are just so many things like that are just so funny, and they're just kind of very subtle.
It's a gem. It's a gem. For sure.
Yeah, no,
Patrick has no idea what we're
No, he doesn't. But it's a shame that
I
I
did watch some Arrested Development. I know where you're going with that one.
Yeah, and two good Canadians on there.
Yep.
Oh yeah.
Yeah, we got what's the geeky kid's name?
Michael Cera.
Michael Cera, and then the tall guy. What's his name?
Oh my gosh! Now his name escapes me.
Oh.
Will Arnett.
Will Arnett. Actually, for those who are interested, Will Arnett has one of the funniest. Have you ever seen on Vanity Fair? They have these things where they talk slang.
Yeah.
So they'll explain the slang for their country. So you'll get the really good looking guy from Australia doing like what Australia slang is like. Well, Will Arnett does our talking slang in Canada, and it is awesome.
No, I've seen that one. It's good.
Where is that? Where you can just Google that?
Yeah,
shit?
just go Will
it's
Arnett
on
talk
YouTube.
slang or whatever,
Yeah.
and
Okay,
you know,
Google this right
and
now.
he,
Yeah, Will Arnett's hilarious.
yeah, and he's like he teaches you about all Hoser, Chesterfield, rink rat, like all sorts of things in there, right?
Yeah.
Chesterfield, like I didn't realize that people don't know what that is.
I didn't know until I watched it.
Yeah, like there's a whole bunch of things that you don't really know because like sometimes it's what's funny, Lena, is that sometimes the British know our stuff because we have lots of remnants from the British.
Yeah.
And so they'll know it, but then the Americans won't know, and they'll be like, "What the hell are you talking about?"
They're just gonna think we're weird.
Yeah,
anyway.
well, they always think we're weird and stuff. So
Speaking of Canadians, once again, the picture for this week, Keanu Reeves.
oh yeah, he's a good guy.
He's a really good guy.
Yeah.
I had a dream with him not too long ago.
I said, pardon?
Keanu Reeves
Excuse
is one
me?
of those guys that is on my list.
He's on your list.
He's on my list.
Really? It just goes to show
It's
you
not
because he's
because
kind of
he's
weird
not-
looking. Like it just goes to
He's
show
not,
you.
yeah, he's not conventionally like an
I get it.
Oh, she just
guy.
watched she watched The Matrix and watched him do those moves, and she's like,
Oh my God,
he makes my
no.
list.
He's such a nice
no.
guy. Like that on one of the
Such a nice
Matrix, he
guy.
took he made like $100 million,
He
and
gave it all away to this.
yeah, like
or
he gave
whatever.
not all of it, but most of it away. And like a lot of people talk a good game, and he just quietly does it. Like
Yeah.
I love that guy. Like he's awesome.
Really
I actually
kind
shared
guy.
that story with on LinkedIn because I retweeted or like reshared it. But yeah, that was a great story. Just how like all the charitable things he's done. He's
Oh
good
yeah,
guy,
you sent
good
me
guy.
something on LinkedIn. Like you're spamming me.
Yeah.
I actually was like, what the hell was that about? I got
but
a LinkedIn
He's
list.
just a good guy.
No, but I got a
Just all
LinkedIn.
around
I
good
got
guy.
something LinkedIn, like he's Ray Dalio
I
or
spam you
something.
all the
He's like
time. That's
sending
all
me LinkedIn shit. Ray Dalio and my dad are the only guys who use that thing, and then Patrick's like sending me LinkedIn shit. Like LinkedIn, it actually pisses me off. Like because that people can tell if you look at it.
Yeah.
So don't go be looking at your
so-and-so's
old
visited
girlfriends
your
or your old
page
your
or
old
whatever.
flings, because if they pay for LinkedIn, they know you're doing that.
I feel like LinkedIn.
I have a
changed
story that I
into-
would not share, and I'm not going
No,
to.
you
but
of course
You're absolutely right.
No, you have to
You're
share
absolutely
now.
right.
Come on.
No, I can't.
It's
No, I will
it's
not.
the
Well,
after
why
show.
would
not.
you even
I will not.
mention it if you're
No,
not
I-
going to share it? What
I'm
is the
sorry,
point?
but I'm just I was just saying that Kevin is exactly right. It's the only point I wanted to make.
Yeah. Anyway,
Be careful
like
what
LinkedIn has-
links you click on.
LinkedIn has changed into like business Facebook. That's what I
Yeah.
feel like. I get random requests from people that I have no connections to whatsoever, and not in the industry that I've ever been in, and they're requesting to be added to my network, and I have no idea who these people are, and I'm like, I don't really understand why.
one of my my dearest friend from Winnipeg, he when I first got on LinkedIn, And he's like, what the hell? You have no fault. You have nobody there, right? Like for him, he's a real business guy. So for him, LinkedIn is very important. And he's like, you have nobody. He's making fun of me. And then he decided to, you know how you can give somebody accolades for different, skills.
Yeah.
He gave me like food services and buffet management. So like I'm proficient, like literally, like that's what it says. So I always think it's kind of funny that that's what it says on my LinkedIn. But I just tell people, I say, here's my LinkedIn, and I think I put on there, I don't check it. Email me here. And you're welcome to join me. Like I'm happy to connect with you, but please, if you're be careful, because I don't always respond to that, and I'm be better off with the email.
I don't check LinkedIn.
Yeah, well, it's just but you have to be careful. And I'm convinced as well, like that Facebook and all these other places, I refuse to do any stalking, because I know someday it's gonna go, like they're gonna sell it. So if you're stalking like anyone like that, they're gonna know, they're gonna sell it. Like, see everyone that's ever looked at your Facebook picture for the last 10 years, and then that's when So don't do it.
People have no idea what I look like because my picture's been up there for 10 years. I don't look like that anymore.
Yeah, you're like a guy now. But anyways, you should be careful on the LinkedIn. But Patrick, I'm trying to find it. Where did you send it to me? What was it again?
I just retweeted you. I don't know.
You know what? You sent it to my DMs, which is also another thing that I'm not very good at. I get overwhelmed. Don't you find that you get overwhelmed with the?
Yeah.
No, people, everyone. Patrick isn't feeling like he has enough.
I get it quite a bit. It's not that you want to be rude. It's just it would almost be a full-time job responding to all the direct messages you get, right? Like it's. I try to concentrate on trading in the markets, right?
Yeah, no, I hear you.
I don't want to be rude, but it's like you have only so much bandwidth where you can really go and micromanage those types of things, right?
Yeah, no, it does end up being difficult, and I try to answer everyone.
I just try and message you things that I don't know how else to send you, because I don't want to go link it into an email. Sending someone an email is also the same shit. Like what
Patrick doesn't want anyone talking to him. Let's just face it.
No, it's not.
It's like don't send me stuff.
Hey, you got to get into my WhatsApp circle. That's the only place you're gonna get my direct response.
There we go.
That's honestly that's my DM. Like if you got my WhatsApp, you're in the
that's
inner
the
circle.
Inner circle of Patrick. Is the WhatsApp. I agree. Like the WhatsApp is a you're very selective with the WhatsApp.
Yeah. And it's yeah. Anyway.
Well, Patrick, one of these days, can you please let me into your WhatsApp?
By the way, so one of my members that was commenting on the show about my laugh made some sort of comment that I was laughing like
Ernie.
like Ernie from Sesame Street. And so I like just yesterday I went onto YouTube and I listened to the laugh, and I pissed my pants. How freaking bang on it is. It's like, holy shit, I laugh like fucking Ernie from Sesame Street.
Yeah, well, I sound like the snowman in Frozen.
No, you don't. You sound like the son from Family Guy.
Really? Is that what they say now? I like the...
What was his name? What's his name?
Chris Griffin.
Chris, yeah. You sound like Chris Griffin.
Really? Because we did have the one listener that was convinced. He said every time he puts in Frozen with his kids, that he gets overwhelmed with. 1 second. Can I pause? I think that might be my pizza. You guys talk. 1 second.
Yeah. No,
Hello, Kevin here.
I was just saying. I was like, oh, whose phone is that in the background?
Is no one answering the door?
Who's got a landline?
Okay, well, come right up.
That's funny. Lena, leave this in so that everyone can hear him answering it and going to get his pizza. Clearly, the show has run a little long.
Right. Yeah, landline phone.
I think that this is a good cue for us having to wrap things up.
Okay, I'm
Kev.
here. I'm sorry about that.
We kept that in because that's epic. We're just saying that this is a cue that the show has run a little long when you're answering the
landline phone.
The landline. It's actually a voice over IP. It's kind of cool.
Oh yeah. That's what it is. Yeah.
Okay. Anyways, we'll let it go.
Anyway,
but I actually like I'm gonna look and listen to Chris Griffin, see if I sound like him. I certainly look like him if I wore a wig. Thanks, Ernie. And then, but I definitely did listen to the Frozen, and that Snowman definitely listens. I sound like it. And
Was it Olaf?
Yeah, it's Olaf. And supposedly this listener, this kind listener, told me that he puts it in, and he expects the Olaf to start talking about like the markets.
Yeah. I suppose I sound like the reindeer.
Oh, there you go. Okay, well, we'll do our own little Frozen. Okay, on that note, thanks for tuning in. Oh, we didn't actually wish all of our Jewish friends a happy Passover. So if you're celebrating this weekend, have a happy Passover and all the best to you and your family.
Thanks, everyone.
Take care.
All right, have a good day, guys.